they can show me data that's going to support it, so I can hear the idea that they're going to actually see some sort of boom and invest, et cetera, et cetera. But then the idea that they always follow the U.S. on a 6 to 9 month lag, and they kind of started later, I kind of buy that too. So, you know, it's a tough one to parse out.
I'm not going to give my opinion on this, but I will say this. Here's the question for the weekend thinking. Is Europe more like Japan? Or is Europe more like America?
There we go.
That's the triangulation you got to think about.
I'll spend the weekend thinking about that.
You do that.
2 hours away from the payrolls report, Wall Street out with their forecast this morning. Goldman expecting the strongest job growth, and Morgan Stanley the most bearish. Sarah House and the team at Wells Fargo somewhere in the middle, looking for job growth to slow to 195. There's Goldman, Tom, up at 250.
Yeah, Jan Hassi is lifting up here a couple days ago at Goldman Sachs. Sarah House joining us right now, senior economist at Wells Fargo. Sarah, the idea of the run rate on non-farm payrolls is distant from where we are. How do you get from, let's say, a blended average sub 200,000 non-farm payrolls down to a supposed run rate, dare I say, of 120, 100, or even under 100,000? What's the timeline to get to normal real economy job growth?
Well, I think if you're not talking a potential recessionary environment, the runway is still fairly long. So if you think about the typical run rate, it's higher during the expansionary phase. But I think as we see headwinds over the labor market continue to intensify, that I think we're going to get there faster. So we're looking for job growth to slow, you know, probably to that 100,000 range here by the third quarter, and potentially even turn negative by Q4.
Socially, is it a white-collar recession? We've seen the bottom decile, even bottom quintile, do really quite good off of COVID and the pandemic. Is there a character to the slower job market that we're seeing that's upscale?
I think it is skewed towards some more of those white-collar position, kind of company headquarter positions. I think one of the areas we can see that is actually in terms of the average hourly earnings. So if you look at the total average hourly earnings, that's decelerated pretty sharply over the first quarter. So it was just 3.2% annualized in March. But if you look at the production and non-supervisory, so that's about 80% of employment, that's still running a noticeably higher. That was up 4.2% annualized. And so I think you are seeing that sliver of where the weakness is, where some of the earlier job cuts have been. It has skewed more towards those white collar or more professional jobs.
Sarah, we started to get a sniff of rate cuts in July. Maybe even at the next meeting yesterday. That was off the back of some of the price action. Mike Gapin at BFA, rate cuts and an end to QT March next year. Morgan Stanley, Alan Zettner, Q1 next year for the first rate cut. Sarah, where do you see the unemployment rate year end? How does that stack up with what the Federal Reserve is projecting? And what's your call ultimately for when this Fed starts to go in the other direction?
Yeah, so we actually see a pretty similar unemployment rate by year end to the Fed. So we're looking at 4.5%. But unlike the Fed, we see them actually cutting by the end of this year. So it's one thing, I think, to say, no, we're gonna stand pat, we're gonna look through this. But when you see a 1 percentage point jump in the unemployment rate, so well above the threshold for what's considered that the economy is in a recession, we think at that point the Fed's seeing enough weakness coming down the pike that's gonna help further slow inflationary pressures, that they do begin to cut later this year, probably most likely right now, looking at that December meeting.
Sarah, what would you have to see in the market? What would you have to see in the data? For example, what we see in 2 hours' time here with respect to the employment market to change your view that perhaps the unemployment rate isn't rising that quickly and things are more resilient and actually that rate cut wouldn't necessarily be needed?
Yeah, so I think just looking at the continued resilience of job growth. So, we've been expecting a slowdown for really the past 6 months, and we've gotten it to some degree, but not nearly as fast as really all economists have expected, as indicated by the consensus continually undershooting what payrolls have actually printed. So I think that's a big part of it. I think the wage dynamic is a different aspect of it. So again, we saw some tantalizing evidence of wage growth coming off the boil pretty sharply here with the average hourly earnings numbers, but that just wasn't corroborated with what we saw in the employment cost index, certainly not with what we saw in the unit labor costs. And so I think if you continue to see the labor market hang in there and point towards inflation taking even longer to come down, then I think that really changes some of the pricing dynamics and where the Fed cut estimates come in.
We were just talking to Chris Marinak about some of the action in the regional banking stocks, and he said that it was a Fed temper tantrum, basically. People reacting to this idea that there could be vulnerability vulnerability and, oh boy, the Fed's still raising rates and how do we deal with this? Do you think that's going to be the last temper tantrum to emerge? Do you think that there are other temper tantrums that are waiting in other sectors of the market?
Well, I think what we see is when the Fed tightens, even if it's at a measured pace like we saw in 2004 to 2006, you can have later on, you can have some pretty abrupt shifts. So the impact of tightening doesn't all hit at once. And so that's why we're not necessarily looking for a completely linear slowdown in terms of job growth as we move through this year. But thus far, it's been what we would consider a pretty orderly slowdown. But that can shift as we move further into this tightening cycle, and really the effects of what we've seen already take hold.
Sarah House, thank you, of Wells Fargo. Sarah, thank you very much. Let's talk about the jobs market. This came from the CEO of IBM, speaking to Bloomberg earlier this week.
Mr. Krishna.
Being a people manager when you're remote is just tough, because if you're managing people, you need to be able to see them once in a while. You know where this is going, don't you? It doesn't need to be every minute, and you don't need to be functioning under those old everybody's under my eye kind of rules. But at least sometimes, Tommy goes on to say, we encourage you to come in. We expect you to come in. We want you to come in. We want you in 3 days a week.
This is really important reporting by Matthew Boyle. Look for this story, folks. I'll get it out on Twitter here at some point. Arvind Krishna is trying to change the culture at IBM. Good luck with that. And I love it. John, this is important on Jobs Day. They cut 5,000, but in the first quarter they hired 7,000. And then he doesn't mince words on WFO. That's our phrase for 2024. We're all jaded by this, the three of us. I mean, we're not thinking clearly about work from home. But there it is. It's a huge debate.
Tom, we've talked about this a million times. You can solve this easily. Money. That's it. Simple.
In my opinion, that will be the 2 to 3 year workout. Is all of a sudden commuting is going to be part of compensation.
Pick how often you want them in the office. If you want them to live near the office, then whoever does that gets paid X, and whoever doesn't gets paid Y. If you want the luxury of living far away from the office and coming in a couple of times a week, then great. You've probably got access to cheaper property markets too. Fill your boots.
Brent Bramo is like maximum Bramo right now.
I know.
You guys are just picking on me today. Look,
Bramo.
okay, I can't restrain myself, but this is not linear. It's not like suddenly we can all work remotely. And I think that's what IBM CEO is getting at, that there is a cultural loss to companies that go entirely work from home, and you end up having a really hard time bringing them into the fold. So if they don't work in the office, it's not simply, looking at the cost. It's also looking at potential for leadership, looking at potential for understanding the culture. And if you take a look at what's going on now, there was a study that came out. Among U.S. employees who can work from home, nearly half have hybrid arrangements, and just 1 in 5 are fully remote, with the rest in the office full time, which is notable.
The middle child is scathing on this. She says it's a complete con job. People are working 3-4 hours a day. They're doing it off of lattes and, croissant or whatever. She's got all her friends are at cafes doing this.
Oh, there's one word that kills me.
I'm sorry, that's what comes out of the mouth of the middle child.
There's one word that kills me. Culture. That kills me. Tell that to the 5,000 people that got laid off that you just mentioned.
Yeah.
Come in for the culture.
Well, okay,
if you want them to contribute to the culture, compensate them for that. It's as simple as that. If you believe there is value in their contribution to the culture, and yet they're part of this family, but then when they get laid off, it's like, it drives me nuts, the culture line does. It really does.
I'm not talking about how everybody is part of the family, kumbaya, but what I'm talking about is having relationships with people that really make it worth coming in every day. I mean, there is a sense of idea building and sort of the spontaneity that gets built with all of that. It's the culture of interpersonal relationships, not necessarily the culture of complete...
Not even you believe this claptrap. Honestly. Can I just say on the meeting stuff?
Please.
And you pull yourself together, because you know that was... Anyway, I
My
agree with
glasses
you.
are fogging
I
up.
agree with you, but if you believe there's value in it, then compensate people for it.
Sure.
That's the point we're at.
I would
That's
agree.
the point we're at. All roads lead back to...
Money.
Compensation and money. They do. They do. Bottom line. Bottom line.
I agree, but I think that it's important to also have a feeling of connection to what you do every day. I mean, honestly, how many people are just having lattes and don't have connections?
What you're
The middle
asking,
child's
what you're
scathing
asking
on this
is for
racket.
senior management to come in and teach the kids. That's what this is really all about. It's about senior management coming in to teach the kids. That's it.
Who was it that said that you can't really get promoted if you don't come in? That it's really hard?
Krishna,
Yeah,
that's
that was
what
the IBM
CEO
CEO.
of IBM's alluded to.
I mean, pick your career track. If you want to progress, put a suit on, come to work, and do your best. End of story. Be in the office 5 days a week. I'd be that guy. I know I am. That's what I would do.
Right.
If you don't want that lifestyle, I'm not saying it's for everyone.
No, but it's
and you want to
competition,
stay from home and live in a cheap suburb somewhere,
John,
and have the backyard and all the open space, great.
John, the Australian,
whatever.
John, the Australian philosopher James Gorman said it best. You know what? If you're going out to dinner in Soho, you can come into work.
Yes.
He did say that,
That's
yeah.
simple.
Well, it's true. The culture.
Okay, all right.
Oh, yeah. We're a family,
coffee
the
in
culture.
food court.
Yeah.
boy.
Yeah, right.
Kumbaya.
Yeah, and then we're laying off 20%.
All right,
Right,
okay.
you ever sat there and laid off 20% of the family?
I have to get some water.
Kids, this month it's tough, you're out.
Have some tank.
Good luck out there. Futures positive 0.6%. This is Bloomberg.
Lisa, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. In just a few hours from now, the Labor Department will issue its monthly employment report. Expectations are that payroll growth probably slowed in April, with 185,000 jobs added, and the unemployment rate ticked up slightly to 3.6% from historically low levels last month. President Biden's national security advisor, Jake Sullivan, heads to Saudi Arabia this weekend. It's a sign of the administration's push to smooth over rocky relations with the kingdom. Bloomberg's learned that among the people Sullivan will meet with is Crown Prince Mohammed bin Salman. Secretary of State Antony Blinken will go to Saudi Arabia next month. BMW is the latest automaker to upgrade its recall of vehicles with the Takata airbags. It's telling owners of the 90,000 sedans and SUVs not to drive them until the defective equipment has been fixed. The recall covers older vehicles. The Takata airbags are blamed for at least 25 deaths in the U.S. Carl Icahn's Icahn Enterprises issued a dividend to investors after coming under attack from short seller Hindenburg Research. That sent the stock up by double digits after falling more than 40% since the release of the Hindenburg report. Hindenburg claims that Icahn Enterprises' value is inflated by 75% or more. Global news powered by more than 2,700 journalists. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Generates a ton of free cash flow, and if you're not going to buy the stock and Warren Buffett's not going to buy the stock, Apple's going to buy the stock. Tim Cook is an amazing CEO, but he has a challenge here to the extent that he has to broaden his supply chain and move out of China to some degree. The good news is that as he expands into India, he kind of has the footprint of what he did in China.
Great to catch up with Tom Forday there. the senior research analyst at D.A. Davidson, off the back of these Apple numbers. Apple positive in the pre-market by a little more than 2%. Looking at the broader market, 1 hour and 44 minutes away from the payrolls report. Jobs day in America, we're looking for a number of about 185. Some big names looking for a number bigger than that, though. Goldman looking for 250. Yeah. SocGen, who have been really good at forecasting this number, Tom. SocGen looking for 260.
If I look at the standard error of non-farm payrolls, John, I got everybody sort of sliding into this board, and I'm wondering if we're set up for a shock here. I mean, no one's looking for, oops.
Have you got a lean one way or the other?
No, I don't. No, I don't have any strong opinion either. I'm just not qualified to do the silly guesstimate on it, is how I'd put it. I just can't get there. Wages maybe will be interesting with unit labor costs where they were.
Yeah.
But it's going to be interesting. We'll get there at 8:30 this morning. This is a joy right now on Apple because he is decidedly not a fanboy. Pierre Ferragut was legendary at Sanford Bernstein and joins us now from New Street Research. And what I love about Pierre, folks, he's got a distance to him. He's not 4 miles from a latte shack in Cupertino or on the island of Manhattan. Pierre, thank you so much for joining us this morning. I want you to quantify the impact of a price for an iPhone approaching $1,000 because everybody wants the fancy iPhone 14 Pro this, Pro that. And I also want you to quantify that $1,000 because the wireless cell phone companies are helping out Apple. We're really not paying $1,000 for our phone, are we?
Yeah, if you had asked me that question 5 years ago, I would have told you no, nobody would spend like $1,000 on an iPhone. And I would have told you, this wireless company is paying for the iPhone, you pay them back with like outrageously expensive monthly price plans, okay? And I would have gotten that completely wrong. What Apple demonstrated is an extremely strong pricing power, an ability to positively improve the quality of their products and get you to pay that. And what you see today is that, honestly, 2023 is a tough year if you sell smartphones. Everybody's suffering in this industry, Samsung, chip suppliers. And what we saw last night is that Apple, despite having cranked up these prices so much, is actually seeing an iPhone business that is not doing great. There is a lot of pressure. Demand is not very good. But on a relative basis, Apple is doing impressively all right, going through the storm relatively well.
If we look at the income statement, I'm going to call you middle of the road here, not a fanboy, not an Uber bull on Apple. Is the durability of that pricing power the heart of the matter? Is that the future for Tim Cook in Cupertino?
Well, I like the fact that you put me right in the middle, because there is one issue with pricing power. You don't get your average selling price going from $600 to $1,000, and then you can't play that trick one more time and again and again and again. So that's the reason why today, the future of Apple is of course to benefit from these very, very strong unit prices and the scale they have today. But the future has to be elsewhere. We don't think Apple can step up pricing a second time. And so that's the reason why, we're very much in the middle of the road and thinking, yes, Apple is a good business, but what's the growth potential of the earnings power of the business now that the iPhone is at $1,000?
This is it, Pierre. This is such an important conversation. What's amazing about Apple, it's the most researched company on the planet, probably. Them and maybe a handful of other ones, and yet still there is this debate about how to value it. What is it? Is it a growth company? You're pushing back against that. Is it a luxury company with fat margins? Maybe, although you're saying we're testing the limits of how far they can push pricing, so they're certainly not LVMH. Is it a staple? Pierre, what is it? What multiple should you put on this name?
This is exactly the conversation we're having with the team this morning. And it's a very, very difficult question. If you look at Apple today, it's trading roughly between 30% and 50% premium on the S&P 500, right? So you pay 30 to 50% premium to buy a business that is showing the resilience they're showing today. So you know that when things go wrong and are getting tougher for everybody, they're getting easier for Apple. Now, you're paying that premium on a business that cannot grow earnings more than 5 to 10% a year on a normalized basis. Even if you are very, very constructive on Apple, unless you get into scenarios of Apple doing a car, Apple like really changing the world with like an AR headset, they can't really grow earnings more than 5 to 10%. So what's, why would you own the stock? It's 30 to 50% more expensive because there is a quality premium, and then it compounds 5 to 10%, 5 to 10% a year. Yes, maybe, but then it's not like a bad deal. I would say a bad value proposition, a bad equity story, but it's not super compelling. And now, of course, John, the question is, could it be worth like 2x the S&P or something like that? And here, it's a whole debate of, if you look at the next quarter, the team is going to report in July, for $1 Apple makes with the iPhone, they're going to be making more than 50 cents with services. And Tim said on the call yesterday night, they are approaching 1 billion subscribers on their products. And so that's where, the premium you pay for, we know the compounding power of Apple cannot really, escape gravity. Like this 5 to 10% is a bit of what they have to live with. But the underlying quality of earnings and things like that is like, it's a difficult question. It's difficult to have like a firm answer.
But Pierre, there is this sort of big elephant in the room, which is the $90 billion of buybacks and the increase to 4% dividends each quarter, given the fact that this is a company that can just afford to absolutely flush the market with cash. How much does that basically push away all of these nice, neat math and sort of valuation arguments and really challenge the idea of a stock going down significantly from here, as your price target suggests?
Yes, so the price target you refer to is not calling for like the stock collapsing for where it is today. It's a price target that we update once a year and gives an outlook. So if you put it into the perspective of when we updated it, it's actually a price target that tells you we don't expect much to happen on the stock, to be honest. On the dividend, the buyback, of course it's boosting how much like compounding you can expect on the stock. But that's the thing, as an investor, you're like, what's my total return? If earnings power, if free cash flow, if all these metrics, revenues grow 5 to 10% a year, that's a 5 to 10% return. Okay, if the company pays a dividend that grows 4% a year, that means my dividend is following that return profile. So it's not additional value to me. And then how much is the dividend as a percentage of the value of the stock? What is the dividend yield? And you see that the dividend yield of Apple, because it's trading on a fairly high multiple, is in low single digits. So you're talking maybe 8 to 12% total return if you look at how much you get with your dividend and how much you get because the company is growing. And so, as I said, middle of the road, it's not bad. I definitely don't think it's bad. But so you don't have like a significant outperformance opportunity just out of this math. You need more than that, which would be the stock re-rates. It goes from a 30% premium to a 70% premium, or Apple, virtually almost reinvent itself again with an AR headset or with a car or something like really, really new. These are the things that really would move the needle beyond an 8 to 12% return.
Or just spend more time on a call talking about AI, Tom. That usually gets you about $10
that's very cool
in the pre-market.
That was wonderful.
Pierre, really thoughtful stuff. Thank you, sir. Pierre Farragut there of New Street Research. That stock is positive this morning, 2% in the pre-market.
A different view. You've got Dan Ives in the 9 o'clock hour, and he's going to reframe here. Everybody's catching up with Ives at $205 target, and I saw a lot of 190s, more enthusiastic than Pierre.
Is it a growth company anymore? That's the conversation over at New Street. Coming up next, Priya Misra of TD. It's Payrolls Friday, Tom.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg.
The stars are also realigning here with the interest rates, with the banks, with the debt ceiling.
The Fed is dealing not just with a domestic inflation problem, this is global.
You're looking at a potential downturn in the economy relative to the strength everyone was looking for.
This is just another expression of financial cracks appearing in response to the fastest rate hike cycle since the 80s.
We have to ask the question, are these central bank inflation targets too high? And I think the answer to that is, well, quite possibly, yes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The payrolls report, 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.6%. Up on a session, down on the week. The banks have been absolutely hammered. Tom, we're looking for a bounce here on PacWest and Western Alliance. PacWest right now in the pre-market, up by close to 18%.
A bit on the banks, and I take your point, John. It's not just about payrolls today. Payrolls to me is a mystery. I think it's been underplayed. I like that HOTCS has moved up to 250,000 at Goldman Sachs, more enthusiastic off an enthusiastic ADP. Guess what? Nobody cares. What we care about is our local bank. We care about these banks in the news, and the reporting from Bloomberg Finance, I think, has been great as they heal, perhaps, and it's get to the weekend Friday. I mean, that's what these banks have to do.
Before we can get to the weekend, we need to get to payrolls. Let's talk about the mystery of payrolls, Lisa. 185, the estimate this morning.
And the expectation for wages to increase at about the the same pace, about 0.3% month over month, which is still perhaps faster than the Fed would expect. People are talking about how they're not expecting a big market reaction from this. There is a big question about what's going to be the bigger surprise. And I wonder if the playbook for 2023 is have a bias, stick to it, repeat. I mean, that's basically, you can play your narrative out however you want. You can take whatever data points you want, and that's going to be the same thing today as we get payrolls.
Well, let's be clear. The bond market traded on data once this week. It was Monday.
Yeah.
We got the prices paid component of the ISM manufacturing. Rates went up, yields higher. Okay. And then what was the rest of the week? The rest of the week was about financial stress in the regionals, dragging yields back down. So, Lisa, to your point, for many people who've got that rate cut call for later this summer, that's not about the data, is it? That's about something else.
We've gotten data that has highlighted the stickiness of inflation. We've gotten the Fed that says we're not cutting into year end. And people say, yeah, you're cutting into year end. And yeah, there's still this incredible disinflationary force. So again, how much are we looking at the sort of stasis in markets, regardless of what we get today, in about 90 minutes time?
Looking forward to that number in 88 minutes time, just to count you down. We've got a clock somewhere. There it is. 1 hour, 27 minutes.
You're fired up today.
Who are you talking to?
Your equity market positive 0.6% on the S&P 500. In the bond market, yields are a little bit higher by 3 basis points, 340 on a 10-year. Lisa knows where the euro is. You all do. 110. Tom, 110.22.
Yeah, 110.22, and we're going to have to see from that. I mean, I just look at the data, and I guess I go back, as I did on Monday, to the 2-year yield. What was it, 405, 410?
3.4.
Whatever. We went to 379, right now 3.82, and you look at that at 8:30. And then you follow the bank data. That's your Friday as you get to the weekend.
Elisa reclaiming 70 as well on WTI. One to watch in the oil market.
Definitely, especially because that's been one that's been a mystery, with people saying that the fundamentals also don't cohere with some of the weakness that we've seen in oil prices. 8:30 a.m., the latest data point that perhaps you could just dismiss, U.S. payrolls report for the month of April. It is important. It will give us a sense of where the labor market is, particularly with wages. If they come in around the same 0.3% month over month or a 4.2% year over year, we're not necessarily seeing a decline in terms of the pace of increases, and that will present a challenge for the Fed. Today, Fed Speak includes St. Louis Fed President Jim Bullard at 12:45 p.m., Fed Governor Lisa Cook at 1 p.m. Unclear what they can say that will move markets. People still trying to parse out where the dissonance really lies, the dissent on the Fed that we really haven't seen in the voting. And this weekend, Berkshire Hathaway gets together in Omaha, Nebraska. They have a 5K, I believe, on Sunday, if you want to head out to Omaha and race in the 5K. It's called the Festival, Annual Shareholder Festival. I was looking it up. But as you were pointing out...
That sounds like a cult.
But, you know...
What you're describing sounds like a cult.
Check it out.
I've never been.
I was looking at the website, and they have, very colorful kinds of, advertisements.
Okay.
It used to be valuable, and then it got, as John respectfully says, culty. Is that the right word?
That's what it feels like.
Yeah, and... To your point early in the last hour, folks, Lisa Bramwitz brought up this idea of Mr. Buffett and his team and hydrocarbons.
Yeah.
And that's what I would take notes on this weekend.
Well, all of the
Occidental
missteps.
Petroleum and the rest.
They said in 2008 they would never invest in oil. Then they loaded the boat with oil, where they now have a higher concentration of oil investments
Chevron
going back
and Occidental.
to early 2000. And to your point, John, banks. Are they going to go into the regionals, especially given the fact that traditionally they have been part of the rescues, and now they are raising concerns about commercial bank valuations, commercial mortgage valuations, and some of the assets on the books.
Sound of their silence has been deafening around this story. We got a tease, a preview maybe from Charlie Munger, the vice chair of Berkshire Hathaway. If you haven't seen that, look for it in the FT from the last week or so. I thought there was some strong indication as to whether they're going to step in or not. I think that was a pretty strong read that they won't be anytime soon.
Why would they, if they're saying this is a huge canard and this is something that's problematic and that's going to have longer lasting effects? Now they're going to say, okay, we're going to come in. I mean, a cynic would say they're trying to push down the valuations to get in at a better price point, but I'm not a cynic.
You got to get the maximum Bramwell.
You got to run a 5K at an investor meeting. Priya Misra joins us now.
That's 3 miles.
Can you imagine?
Anyway,
like 3.5 miles. Head of global race strategy at TD Securities. Priya, wonderful to catch up with you. Priya will not be going to that or running that 5K with them anytime soon. Priya, good to see you, as always. Priya, let's talk about these numbers out later. Lisa's on the money, I think. Does this data matter to this bond market later on this morning?
I don't think so. I think we're all watching banks. I do think that the reaction will be a bit asymmetric. So if you get a weaker number, I think the market's already on sort of what we're calling a recession alert. So that recession alert starts to flash a lot more if the data is weaker. We're actually looking for slight downside surprise. We're looking for 150,000. But I would highlight anything above 85, 90,000. is actually above trend. So I think it just tells you how difficult the situation is for the Fed and the market that's hoping for some Fed relief
I think
here for a quick Fed cut. That's not happening.
Priya, people are shell-shocked when you look at a 3-month, 10-year spread and the other spreads that are out 2, 3, 4 standard deviations. I mean, it's an unusual time. Where does the 10-year settle out 12 months from now when we de-shock?
So I think 12 months from now is actually almost an easier call than the next 3 months, because I think 12 months from now, a lot of the lags from monetary policy, as well as the lags from credit conditions that we know are tightening as we speak, I think they start to play out. 12 months from now, we think the Fed is aggressively cutting rates, because even if inflation is above 2%, it would be much lower than where it is right now.
You're not giving me a number. Priya, give me a number here. Are we going under 3%? Is that the news of May of this year?
We are. Yes, we are. I actually think we could get there by the end of this year. You're asking 12 months from now? Yeah, I think we're looking at 250, 275 with a Fed that's cutting aggressively.
Priya, I want to go back to this idea that the data doesn't matter at a time when people basically are saying we haven't seen the effects of everything. And so we just have to wait for a bit. What are you looking at then in the meantime to get ahead of that? Is it just simply the senior loan officer survey, or do we just find out from the Fed chair that it's not going to matter and it's just going to confirm what we've already seen?
I think we will be watching at the details of the senior loan officer survey, and also what's the end game for the banks. Right now, there's a game of chicken here between the larger banks that want to wait for the FDIC to take a loss, the smaller banks that keep getting sort of lower in terms of valuation. What's the end game? Does the FDIC put forth this unlimited deposit insurance? Does it keep getting worse? Is this a slow burn? We're actually thinking this is somewhat like the savings and loan crisis, where banks just continue to fail, and that's going to tighten lending standards as we speak. So as much as the SLOOS report's going to be important, we'll be watching for how much worse is it going to get. So I'm watching that. I'm also watching what's happening on QT. I think it's the least appreciated form of tightening. So as long as the Fed is doing QT, which they're telling us they're going to keep doing, deposits keep leaving the banking system. Now they're also leaving the banking system for money market funds, but they're being extinguished by the Fed. Does the Fed do anything with QT? I'm not very hopeful that they will. So, I'm watching sort of Fed response, what's happening with the banks, and sort of real rates. As long as real rates are well north of 1%, which they are, or I would say even 50 basis points, that means policy is restrictive. Policy is restrictive. We still have to see the lags play through. That's why, our conviction on the slowdown just continues to get stronger. I hope that there's an end game really quickly for the banks. But if there isn't, I think we have to reassess how much the Fed's going to have to cut next year. Not this year. I think they're going to be very reluctant to cut rates. But when it's clear that the unemployment rate is rising very fast, we're getting close to 5%. I think, at that point, we have to reassess the Fed's going to cut a lot.
Priya, I'm interested in your interpretation of Chairman Powell this week, and it's different for everybody. Did you get the impression that he was saying there is reason to be calm because there is reason to be calm around the financials, or did you get the sense that he's saying that because he's got no choice but to say that?
I think it's a little bit of both. It's not a cop-out answer, but essentially they're trying to buy time. It's not up to the Fed to solve the banking problem. They did what they could do. They provide a discount window. They've got BTFP, but they cannot solve the capital problem. That's something the private sector banks have to do. That's something the FDIC has to do. I actually think we need a TARP-like system from Congress. So what the Fed's trying to do is say, you know what, ball's in somebody else's court. All we can do is provide liquidity and buy time. So I think he was trying to keep all options open, suggest a pause. But if the data remains strong, if the banks start to stabilize, I think the Fed can potentially even hike further. So he was just highly non-committal in our view.
Priya, are you not of the opinion then that this regional banking system is struggling with 5% interest rates?
They are, but it's the Fed's job to help the banking system right now. I would say, this idea that they can separate monetary policy from financial stability, I actually highly disagree with that. The way monetary policy works into the economy is through the banking system. So some of this tightening is the intended consequence of tightening. This is now for the private sector and for the government to figure out what happens with the regional banks. I think the Fed has a very clear mandate from Congress, which is the labor market as well as inflation. So I think they can pause. They're not going to want to cut soon. And I think because they'll be late to start to cut, they're going to have to cut a lot more. But yeah, I think, as much as I think what will really help the banks is if the Fed starts to cut rates significantly. I don't think that's the reaction function of the Fed right now, given the economic data we're living with.
Inflation still at 5. Priya, thank you. Priya Misra of TD Securities on this bond market. Tom, with more conviction there about the slowdown that's around the corner.
Absolute tour de force that you just heard there, folks, on a time frame of 3 months. In her time frame out 12 months, can you imagine these banks and the salvation they feel with a price up, yield down bond recovery, a disinversion, if you will?
The conversation continues next hour. Nadia Lovell of UBS on the equity market. Equities right now positive 0.6% on payrolls Friday. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. jobs report may show the resilience of the labor market. April's report is expected to show that employers added 185,000 jobs and that the unemployment report ticked up 3.6%. That's only 0.2 of a percentage point off the 54-year-old record. The jobs report out at 8:30 New York time. U.S. regulators plan to make the biggest banks pay most of the bill when it comes to replenishing the government's deposit insurance fund. Bloomberg's learned that small lenders won't have to kick in extra money. The insurance fund was depleted by the failures of Silicon Valley Bank and Signature Bank. President Biden reportedly will name the Air Force's top general to become the chairman of the Joint Chiefs of Staff. That's according to the New York Times. General Charles Brown, the Air Force Chief of Staff, would become only the second black man to serve as chairman. Colin Powell was chairman under Presidents Clinton and George H.W. Bush. Sales of Apple's iPhone rebounded last quarter. That's helped the world's most valuable company beat earnings estimates. Sales actually fell 2.5%, but Apple had warned investors to expect a drop of roughly twice as much. The results suggest that Apple is recovering from a slump that's plagued both the computer and smartphone industries. And there's a sign that the electric vehicle price war in China may be taking its toll. Shipments from the Tesla factory in Shanghai fell almost 15% from March to April. Tesla triggered a slew of discounts and incentives offerings from other car makers when it slashed the prices of its Chinese-made EVs at the start of the year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Was going to keep rate World Cup. This is a 3
as the economic picture does.
The BOK is getting ready to make a decision.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. All eyes eyes turn to the U.S. job market.
There are already some signs the labor market is going to weaken.
We've just started to see recently claims just tick a little bit higher.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a really, really good report for minorities.
Can we get a painless disinflation?
This is a chairman that wants a 4.x% unemployment rate. The microdata doesn't show that.
The April jobs report, today on Bloomberg Television and Radio.
We need to change the limit on deposit insurance. The situation we have right now is we have effectively unlimited deposit insurance. Only the difference is that the billionaires who are taking advantage of it and the billionaire banks that are taking advantage of it are not paying for it.
I swear the control room's winding me up playing that again. Senator Warren, I have no idea what that was about. Do you? Can you translate the last bit?
It was
What's the last bit mean?
I'm advocating for you, common person.
That's all okay. Well, there's nothing wrong with that, but did it make sense?
No, not
Right,
from any
okay.
policy
Look,
perspective.
where this is going, let's assume that the bank thing, as Priya Misra just said, continues on and, you know, it's a slow motion thing, whatever anybody's theme is. We're going to end up with 7 guys standing up with Jane Fraser with their arms up in the air in, you know, it's going to be a photo opportunity in front of Congress. Then what? And what are they going to do? You know, they're going to pass what? Certain, maybe deposit insurance, you know, they'll do something there, I get.
But when she's talking about the billionaires who are taking advantage of it and the billionaire banks that are taking advantage of it and not paying for it, what does that mean?
I have no idea other than she's conflating the marketing plan to give Mark Zuckerberg a 1% or 2% mortgage as a billionaire with what's going to actually happen with the big banks on Park Avenue. They're going to pay a ton of fees. PNC in Pittsburgh is going to pay a ton of fees, et cetera, because of this banking debacle.
The past couple of months has made the political narrative very complicated around the banks because it's been very popular to bash the biggest banks as being too big to fail, of being sources of stress. And in this latest banking crisis, they have stepped up and they've been stable. So then how do they go after them at a time when, at least from a political standpoint, and say that they were the bad actors? And then who do they go after? The regional banks that have the votes for a lot of the constituents. I mean, this is really some of the calculus politically that makes it very difficult to understand what the policy.
Have you noticed that anything they don't like these days, you just put billionaire in front of it, and it's like billionaire banks. Like, just pick anything you don't like and just put billionaire in front of it. It just sounds so much worse. I'm here for you. We're after the billionaire, whatever, you know. It's meaningless stuff. It's just ultimately meaningless stuff.
A little much more honest, and of course we will cover this on Balance of Power, starring Anne-Marie Horton and a cast of characters, Joe Matthew. Kaylee Lyons there last night, I believe. Our Bloomberg Washington correspondent Anne-Marie Horton with us this morning. Anne-Marie, I about fell over in the Washington Post this morning as Governor Reynolds of Iowa is going to drag us back to the child labor laws before I was moving bags of oats around at an Amway a million years ago. I was thunderstruck by the language of Iowa to get 14-year-old kids in, quote, construction and demolition. What in God's name is going on in Washington and our states on this jobs day over kids 14, 15, 16 having real jobs like that?
Well, this isn't actually a debate at the moment in Washington. This is taking place at the state legislature in Iowa, and there's been some fierce debate about it. You have critics coming out and saying, as you say, this is bringing us back to a time, this is unsafe, but others are saying, actually, this is good for accessibility for the individuals in their teens to get access to the labor market and can potentially work till 9 p.m. and there's other provisions like that. But I think what you're hinting at, Tom, given the fact that it is Jobs Day, is that what we are seeing in a lot of states is they are struggling at times with this tight labor market for certain jobs, especially as we see more manufacturing plans, given what you have with the CHIPS Act, given you have the Inflation Reduction Act, coming back to America.
I mean, Lisa, I'm going to quote this verbatim or I'm going to get in trouble. This is verbatim to my editors. It also bars workers younger than 18 from working in, quote, establishments where nude or topless dancing is performed, unquote. I've never seen a story like this ever on labor on this Labor Day. This is, like Anne-Marie said, I believe this is not a Washington discussion, but this is what's going on in the middle of America.
What are we talking about? Why did that strike your interest so much, Tom?
Because we spent what, 200 years trying to get labor laws across a broad swath of America. John, help me here with England. I mean,
I'm not
they
helping.
had kids in the coal mines.
You keep digging.
Oh, come on. In England, you had kids in the coal mines.
What are you talking about?
Do you want the elephant in the room, the number?
Yeah.
Unemployment in Iowa is 2.8%.
Yeah. Exactly.
2.8%.
Thank you. Well done.
Well, okay, so this goes to the labor market report, Anne-Marie, that we're getting out. Not necessarily children working in topless establishments, but I am wondering whether this is going to be a good thing or a bad thing for this administration.
Friday.
If we get, tell me about it, if we get a bigger than expected number. In other words, what is Washington hoping for with respect to the labor report? How are they going to spin it after it comes out?
Listen, what you see this administration constantly do is find the one great part of the labor report, and they say, or usually it's the in CPI days as well when it comes to inflation, and they spin that forward. So obviously, if it is a low unemployment number, they will say that they have added XYZ number of jobs. They have this, pre-pandemic record low unemployment, and that is because of the Joe Biden economic agenda. If there is slowing of the labor market, and we do see the unemployment rate tick higher, not lower, the administration will come out and say, well, we need to be seeing this. We want to see a controlled slowdown in the economy to make sure that what the Fed has been doing is working, and that's to get inflation low. So either way, you're going to get a spin.
Is anyone planning any legislation down in Washington with regards to the banks? Is the White House promoting any legislation that should be passed through Congress at all? Anne-Marie, the comments that I heard from Karine Jean-Pierre yesterday, they were a classic. I think we turned it into a promo here on Bloomberg Surveillance. It said something like, we're monitoring developments in regional banks. They're monitoring it. It's just like meaningless stuff. You know that, Bremer, they go into these press conferences. You know what happens? They take that big book and someone asks about the regional banks and they flip through it and they get to page whatever it's on and it says, we're monitoring the situation with regional banks. Anne-Marie, what on earth does that mean?
That means that they do not want to speak about the banks, but they have to have something to say, so they are, quote, unquote, monitoring it. No, but in all seriousness, there are people at the White House who would be monitoring the banks, the likes of Lael Brainerd, the head of the National Economic Council, the likes of Treasury Secretary Janet Yellen. Obviously, they are looking at what's going on. What they are doing in terms of the concerns around the regional banks is any chance they can get, they are talking about more regulation. And they really point back to the rollback of these Dodd-Frank laws, which, again, were passed in a bipartisan way under the Trump administration. But what they're saying is that Congress should be doing more and there should be more regulation. We hear from the Republicans in Congress is that the regulation is already there. The supervisors just weren't using it.
AMH, thank you. Anne-Marie, down in Washington, D.C., Bramo with the lean.
Well,
I
okay,
can see it. Go
can
on.
I just give a public service announcement to politicians, just in general, that when they say certain phrases, John is on a tear to point out how meaningless they often are as they go out. And, I love this. It's sort of an existential week for you. You got to the point where you're just like, it's all meaningless.
I've
Why?
had enough. It means
I know.
nothing.
Okay,
means
look,
nothing.
a lot of
Monitoring
things mean
it.
nothing, but people are trying to parse through a nuance, and it doesn't play in politics. I keep going back to that. They can't be like, well, we think it's okay. We're not sure. We're really concerned.
Well, what I care about is policy. What I hate is politics. What I care about is policy. And when you start talking about the regulation and the rollback under the Trump administration, supported by some Democrats in Congress, by the way, which often doesn't come up when the White House talks about this, when they do that, great, that makes sense for a long-term approach to the financial system. I think we're all on board. That's something we should discuss. But in the immediate right in front of us now, we need to talk about, okay, do we understand how they've diagnosed the problem? How does the White House see the problem in the regional banks right now? Is it something that needs to be addressed with FDIC deposit insurance, changes to that, in which case then we should be pushing Congress to do something there? Is it because interest rates are too high? What is going on there? Because at the moment you've got bank failure after bank failure in the United States of America. I'm not convinced that I've got any idea what they actually think about it other than that they are monitoring it.
Well, it goes to Priya's point, right? When you asked her this question, first Jay Powell basically saying everything is fine because he wants to imbue the market with confidence or because he actually thinks it's fine. She said both. Well, how much is that policymakers too? We're getting a handle on it. Are they? Do we have a sense that they have any clearer notion of it? We just don't know. And so at what point do you sacrifice, the idea of pushing the markets for credibility?
Equity futures right now positive 0.7%. Payrolls 1 hour and about 4 minutes away.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Someone messaged me about a month ago, 6 weeks ago, and said, John and Lisa are on air talking really fast. It must be serious. Yes. I'm not sure this morning is serious. Do you remember that message? You got that too?
Yeah, if it's Sunday night and John and Lisa are on the TV speaking quickly, you know there's things that get serious.
Yeah, it must be serious. It must be really serious. Okay, anyway. Your equity market looks like this. That was just mumbling, not fast, don't worry.
No,
that was
I'm the one that mumbles.
0.75% on the S&P 500. On the NASDAQ, up by around about the same amount. We're down on the week through Thursday, 4-day losing streak on the S&P 500. The longest losing streak going back to February. If we closed the way we were on Thursday at the close, it would be the worst week on the S&P 500 since the week the SVB failed, ending 1/10. The regionals bouncing back, the small caps too, the Russell up by more than 1 full percentage point. Outside of that, the likes of Apple doing okay in the pre-market, up 2.8%. They beat estimates after the close yesterday. We'll talk about that name a little bit later. In the bond market, big range on the 2-year this week, through 4.16% at one point on the 2-year early this week. And then we got down as low as 365. We've come back to about 382.29, Tom, on a 2-year this morning, up 3 basis points.
What you did with that great data check is the idea the bond market is nuts, to borrow a phrase from Angry Beavers, and the equity market, SPX, is at 4,100. If you told me the bond market you just verbaled, I would say 3,800 on SPX in a heartbeat. We're not.
The post-SVB low on a 2-year, 355. So we weren't too far off that level in the last couple of days. I will say this, though, about the equity market. Banks failed in March. The S&P 500 was up on the month. We had the prospect of a bank failing in April, went into May with that. The stock market ran it in April too. So there you go. It's been pretty resilient. And that trading range still sticks. 3,800 to 4,200. Still sticks year to date so far. Outside of that, let's get to the foreign exchange market just to wrap it up for Lisa. In the FX market, the euro at 110 against the US dollar. 110.21, Lisa, and basically unchanged on the session.
Wow, that's cool.
Anytime.
And thanks, I appreciate that. By the way, talking about stability, Apple, we should say, up about 2.5% in pre-market trading after their earnings yesterday. And how much is that the entire story of stability in the index, right? That is what we're talking about, is a tech rebound, not necessarily what we saw in some of the underlying stocks. So Apple shares up 2.75%, 2.75%. With people just seeing that iPhone behemoth just continuing to mint cash. I do want to give you a sense of the banking rebound that we're seeing today. PacWest, Western Alliance, and Metropolitan Bank Holding all up, led by PacWest, shares up nearly 20%. The why here, I really don't know, but a lot of people are pointing to the report out of the Fed yesterday that talked about a decline in some of those emergency windows, although I do think a lot of that is attached to First Republic being taken out of those estimates. So what can we actually glean from that? It's sort of like pick your narrative and tale of roulette, and that's sort of where we're seeing this whipsaw action go. I also want to just point some of the other shares that really have been reacting to earnings. Carvana, remember that was like the zombie left for dead because who's going to buy their car online when you could do that from all the other dealers as well? Those shares up almost 40% after saying they're going to return to profitability. Of course, their shares were up to $250, $270 a couple of years ago. So still, it's pretty far down from where we were. Also seeing DoorDash up almost 4%. People are still getting their salads delivered to them and paying premium for it. And Lyft, and this is a story we keep talking about in terms of consolidation of market share. Lyft shares plummeting almost 16% after showing that they're kind of really struggling to compete with Uber. It's just really tough.
But they're not Uber. It's that simple, isn't it?
It's that simple. And this is a tough market. And so how much do we continue to see consolidation of market share?
Lift down a little more than 15%. We are about 60 minutes, a little bit less than that, away from the jobs report in America. Ray Farris of Credit Suisse and a team expecting payroll growth to slow to 190,000, saying this. Broader labor data point to some deceleration in job gains, and the composition of recent payroll releases, Tom, suggests that employment growth in the most cyclical sectors, manufacturing, construction, is rolling over.
A view from Credit Suisse, and very importantly, a view from a different economist. Ray Farris is chief economist at Credit Suisse for the Americas, but far more with important tours of duty on the Pacific Rim, which gives him a different perspective. We'll get to the Pacific Rim in a moment, Ray. Let's talk about the American labor economy. I'm told the run rate is 100,000 non-farm payrolls, maybe 120, maybe 85. I'll let you tell me. But the answer is we're distant from that this morning, right? Even whatever the number is this morning, we still have a buoyant labor economy.
Absolutely. I mean, we have a forecast of 190. Since the ADP numbers came out, I'd have to bias that to be over 200. The thing to do here is to kind of get pre-pan on you, right? You know, think about where we were in December of 2019. We had an unemployment rate of 3.5%. The 6-month average for payrolls, and in a time when the economy was clearly growing, nobody was talking about recession, it was all good, 167,000 a month. And we're about to, with an unemployment rate of 3.5%, we're about to print sort of 200 plus. This is the Godot recession. You know, it's just, we're still waiting for it. And the problem that the Fed has is not recession. The problem the Fed has is there's just too much growth.
So what do you see in the cyclical sectors right now that was mentioned in your note? Is there any sign whatsoever that the interest rate increases of the last 12 months are starting to bite in some way, shape or form?
Absolutely. So what's beginning to happen is that the goods sector is beginning to soften. Housing is beginning to bite into elements of employment there, in real estate, in construction, especially in finished carpentry and those types of things. But the fact is, for this level of GDP, the economy is running at least 1 million jobs short. And that 1 million jobs short is in the services sector. It's in healthcare, it's in travel and entertainment, and it's, interestingly, in local government. So there's some degree of rollover in, goods and construction, but we're still going to add jobs in those services sectors. And that's the Fed's problem. It's not even so much the average hourly earnings, the wage growth. It's just simply that we keep printing lots of jobs. People have got jobs, they got money, they go out and they spend.
So if you say this is the Godot recession, and basically it hasn't gotten here, inflation's still hot, at what point do you just revise the outlook entirely and say, okay, we're not going to necessarily get any sort of downturn, rate cuts completely off the table, and this is one that we can actually see an economy that chugs along for quite a bit of time?
Well, the economy is slowing. We were 3% growth in the third quarter, 2.6 in the fourth quarter, 1.1 in the first. We're going to probably go down sub 1 for most of the rest of the year. The Fed's, I think markets are overpricing the likelihood that the Fed's going to cut rates by the end of the year. I think they're just too optimistic about that. You can't have a bust if you haven't had a boom. And the credit-sensitive parts of the economy, thinking about, getting a credit crunch of sorts, the credit-sensitive parts of the economy are business equipment spending, structures, both residential and commercial. And if you look at those things, well, business equipment spending is 7% below trend. Everybody talks about commercial real estate. Non-business structures investment is 16% below its pre-pandemic average. And residential construction is 6% below its trend. And we got a shortage of houses.
You on the high ground on the Pacific Rim and the China analysis from a U.S. perspective with your foreign exchange work at Credit Suisse over the years, do you believe in a 6% or, dare I say, even 5% China GDP? Can they get it done and persist with that kind of GDP?
They can definitely have a 5.5%, 6% year coming off of a couple of really bad years. No. Growth is probably going to slow back down to, if they're lucky, in 2024, high 4s. The problem China has is it now has a policy environment, a political environment that really is a major constraint on the private sector. And crucially for the global economy, for us, for Europe, that recovery is very insular. It's all about domestic services. You're seeing this recovery in growth, but a fall in imports. So it's not having any meaningful spillovers that are boosting global growth.
Are they leaning towards Chinese brands? What are you noticing there about the nature of that domestic recovery, that domestic services boom?
Well, it's all about going back out to restaurants. It's about travel, and it's focused domestically. Remember also that, China it had bouts of lockdowns, but it never really had a big shutdown of its manufacturing complex. So, manufacturing is not actually below trend. Consumption of goods is not actually below trend. What's below trend is consumption of domestic services. And that just doesn't use a whole lot of copper. It doesn't import a lot of capital goods. Doesn't spill over.
Ray Farris of Credit Suisse. Ray, smart, as always. Thank you, buddy. We are about 50 minutes away, 51 minutes away from the payrolls report. Coming up at 8:30 to break that down. Jeff Rosenberg of BlackRock reacting to those numbers. Looking forward to that conversation. Fantastic lineup in the next hour. If you are just tuning in, welcome to the program on TV and radio. This is Bloomberg Surveillance, looking for a number of 185,000. That is the median estimate in a survey that we conduct monthly. 185, Tom, is the number. That's down from 236 the previous read.
Let's go over payroll 101. The standard error on this is huge. If you have a number of, pick a round number, 200,000, what's the gap where you can say, well, I didn't get it right, but I was within the error? And we forget.
Wait for the revisions.
Help me, Ray. 1 divided by the square root of n. Is it something like that? Am I close? Whatever it is, the standard error is a Ray Farris football field wide.
So at 8:30, should we just ignore it, TK?
A lot of pros do, but they do go beneath the headline data, which we'll do here on Bloomberg Surveillance.
The pros may, but the market usually does move somewhat. And I do think the more that I start to look at what everyone is saying in terms of pick your bias, stick with it, What do you think an upside surprise would do to this assumption that Fed hikes are
Well,
working?
the Hotzius number, 250,000 away from Ray Ferris and the others. That's the question.
It will reinforce this idea that monetary policy is in conflict with financial stability because they're going to have to hike interest rates too much if you have to keep on pushing out that call for higher unemployment.
Do people then capitulate on rate cuts by the end of the year? Or do they say, well, no, because that financial stability piece will come into play? I mean, really, it is sort of, people can make the argument to confirm their narrative, and it's convincing either way. I give it to them.
As you've mentioned, and we've talked about through this morning, these cuts are priced in for later this summer. Slowly that's happening. It built up yesterday because of financial stress in the regionals, and it has absolutely nothing to do with the economic data, does it?
No, and then there's this question of, okay, well, was it idiosyncratic?
Each and every bank, idiosyncratic.
If I can chime in.
You can. I've got 20 seconds.
You
Go
got
for
20
it.
seconds, go.
The way to think about those rate cuts by year end is they're fire insurance. They're basically the market saying the direction is something's going to blow up or could blow up. And if it blows up, the Fed's going to cut 300. So we got to have some fire insurance in there.
I hear you. You're not the only one saying it. I've heard that a few times, that either we've priced in too much or not enough. There's kind of like no in between. If they need to cut this year, it's because they need to go big.
Ray just cut it like Illyrian does. I mean, he was on the edge of Muhammad there. I mean,
Just
excuse
as
me, I got one more thing to say.
There's a show to anchor, Ray, in about an hour and 20 minutes if you want. I don't really mind. In the equity market on the S&P, positive 0.7% on the S&P 500. Payrolls, 48 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, just like Jonathan said, in just under an hour from now, the Labor Department will issue its monthly employment report. Expectations that payroll growth probably slowed in April, with 185,000 jobs added, and the unemployment rate ticked up slightly to 3.6% from historically low levels last month. President Biden's national security advisor, Jake Sullivan, heads to Saudi Arabia this weekend. It's a sign of the administration's push to smooth over rocky relations with the kingdom. Bloomberg's learned that among the people Sullivan will meet with is Crown Prince Mohammed bin Salman. Secretary of State Anthony Blinken will go to Saudi Arabia next month. In other news this morning, in Serbia, President Aleksandar Vučić promised that there would be significantly tighter gun restrictions after 2 mass shootings this week. Now, Vučić also announced a buyout of weapons in what he called a disarmament. A school massacre in Belgrade and a shooting rampage outside the city left at least 17 dead and 21 wounded. The UK is preparing for its first coronation in 70 years. King Charles III will formally accept St. Edward's crown during a service Saturday at Westminster Abbey. The coronation is expected to be a gift from the country's pubs and restaurants. Still, because it also includes a national holiday on Monday, there's speculation the whole thing could lead to a slight drag on GDP in May. And the parent of British Airways in Iberia raised its full-year earnings outlook after reporting a surprise profit in the first quarter. IAG highlighted how the airline industry has bounced back from the worst pandemic slump. The company has benefited from lower fuel prices. Meanwhile, demand has driven up airfares faster than inflation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Apple generates a ton of free cash flow, and if you're not going to buy the stock, and Warren Buffett's not going to buy the stock, Apple's going to buy the stock. Tim Cook is an amazing CEO, but he has a challenge here to the extent that he has to broaden his supply chain and move out of China to some degree. The good news is that as he expands into India, he kind of has the footprint of what he did in China.
Tom Forday there, the senior research analyst at D.A. Davidson, live from New York with Apple up in the pre-market, going into payrolls. About 44 minutes from now, your equity market just about positive as well on the S&P. The regional banks, which were in trouble yesterday, doing better this morning, up 20% on PacWest. Western Alliance up more than 15%. And this line just coming through from Andrew Hollenhorst of Citi, who said on Monday, we hypothesized that the resolution of First Republic would draw a line under the period of deposit concerns and refocus markets on macroeconomics developments. We were wrong, at least in part. Deposits have been stable since late March, and banks have not, in aggregate, sought out new emergency liquidity from the Fed. The most recent movements in bank equity prices are more about general confidence than deposits. Tom, that would be a more difficult issue for regulators to address.
It's a difference in deposits, and I've noticed, I would say Wednesday, it's been such an exhausting week, John, I'm not even sure which day to quote, but I'm going to say on Wednesday there was a flip from deposit dynamics, yes, but now we're over looking at normal marking bonds and credit dynamics as well. And then you even go over, you take it further and say, no, Tom, it's not about credit dynamics. It's just about this crazy bond pricing that we see within a basic bond data check. You can pick your medicine there, or maybe it's all three. As we go to Priya-Misra's statement, we're going to see this extend out.
So as we identify the issues, Tom, and you've done a great job of just going through many of them there, on deposits, it puts them in a tough spot because every time they come out and talk about them and say things are okay, it doesn't really make a difference. Western Alliance have said basically the same thing PacWest have said. The bank has not experienced unusual deposit flows following the sale of First Republic. That was Western Alliance. PacWest, the bank has not experienced out of the ordinary deposit flows following the sale of First Republic.
To the two of you, if we get, I'm looking at BTMM on the Bloomberg, no one's framing a 6% money market fund, or 5.8%, dare I say. Let's not be inflammatory, but can we, before we get to Priya-Misra's sub 3% 10-year yield a year out, do we move higher in yield, moving those deposits ever more towards the highest rate?
To put the two ideas together, on one hand, deposits might be relatively stable at some of these banks now, but on the other, there has been this drip, drip, drip of deposits out of banks, raising questions about the profitability and viability of some of the models that really grew up in an era of zero rates. And I think that is the challenge at a time where $588 billion has gone into money market funds over the past 10 weeks. That compares to $500 billion after Lehman's collapse. So that is just sort of the apples to apples comparison, this versus via Michael Hartnett of Bank of America.
On a sleepy Friday afternoon after the surveillance nap, we get more data today. I believe there's more bank data coming.
Bank lending data,
Bank
lending data.
Yeah, more data.
Look, you've got to work out what the underlying issue is. Is it just about deposits? It's other things too, but let's go with deposits and then work out, is it fear or is it greed? Is it fear because you're worried about return of capital, so you're taking your money to another financial institution? Or is it ultimately greed? It's about return on capital. And to your point, Lisa, you're putting it in a money market fund, rates are at 4 or 5 and maybe higher, who knows where this is going. and they can't keep that money in-house because they can't offer that money on those deposits.
The problem with the banking model is that there is a very narrow line that's very hard to distinguish between fear and greed. This question of they live and they die on reputation, on their ability to lend and their ability to profit from that. If that goes away and people lose confidence and they restrict the number of loans they start to extend, then that really tightens the credit conditions and it becomes more of a credit issue.
Well, it's important for policy. That's why I raised the distinction between the two things. If it is fear, then you can address it with a new FDIC limit, right? Because then you know your money is safe. If it is greed and it's just about returns, it doesn't matter what the limit is. I'm just going to the place which offers me the biggest returns, and some of these regional banks, Tom, can't offer that.
It's more complex. I think Senator Warren's quotes to Bloomberg here in the last 24 hours talks about the greed that's out there. It's always there. It's always present. Michael Spence's 2010 essay on this was textbook. The greed never goes away. The fear never goes away. Also never going away is Anurag Rana, our senior technology analyst, truly expert on the cloud, and from the cloud with Bloomberg Intelligence, expert on innovation. Anurag, I don't want you to do a sell-side walkthrough on Apple. I want to talk about Clay Christensen disruption, innovation, and the absolute sweat of new products at Apple with the legacy you and I remember from the massive failure of Lisa and Newton, not Lisa Abramowitz, this is Lisa the computer, years ago. Are they setting themselves up for a flop?
No, I don't think any of these companies are setting up steps for a flop. At the end of the day, these companies have massive amount of data. They have a lot of engineers, going through it. And in each and every way, you see some of those AI-enabled applications show up, whether that's in pictures, whether that's in voice command, whether when you're writing an email. These companies are really working hard to make sure that your next level of products are far more intuitive than the earlier ones.
What is a mixed reality headset? Has Mark Gurman called you up, our Apple expert, and said, well, I mean, am I going to be looking around, like Lisa does when she's Maximum Bramo? Am I going to be looking around with my mixed reality headset?
I don't think so. I don't think that's a game changer from, I would say, a product point of view. It's like an additive product like an AirPod, but AirPods have a very high attach rate. But from a mixed reality, we don't think it's going to be financially that big. But frankly speaking, it's going to truly open a new universe of applications, a new ecosystem by itself that over time, I would say over a 10-year period, will actually generate good amount of cash flow, services revenue, for Apple.
Anurag, is it a good thing or a bad thing that the iPhone really still is the bedrock of the entirety of Apple's business model?
I don't think it's bad. I mean, to be very honest, I look back and I think of Apple more like Coca-Cola, that it's a very, very US-based company that's going all over the world, spreading its best product. And, iPhone is the linchpin. Now, with the other products, as I said, watch. I don't own a watch, but I do own an AirPod. So when you look at an AirPod, you have a very high attach rate. But maybe down the road, if the watch has some more health features, other things, I may go get a watch. So if you are in the ecosystem, you're going to buy, products that's around that ecosystem.
Anurag, what did you make of the emphasis on India and shifting to India as they continue to manufacturing the watches and the phones?
Yeah, it happens. When you come back from India, you talk about India for several weeks. I do that quite often. So, Tim Cook talked about it a lot. But frankly speaking, it generates, less than 3-4% of revenue from India. It's a massive opportunity. I mean, on a population size of it, 90% of the current install base in India, they don't even qualify for an Apple product. The Apple's market share is less than 5%. So as the middle class becomes more rich, they are bound to get the more expensive products. Now, LVMH, Mercedes-Benz, all those products are doing very well in India. And over time, I think Apple's going to do very well there too.
Anurag, is this a growth company anymore?
It depends on what you think about it. I mean, this is such a, safe haven for people. When the banks are blowing up, you really don't want to go on the weekend, worried about what's going to happen on Monday. When you have a company like Apple, you're not going to be worried about it. Even, this year it's going to grow somewhere around 3 to 4% in constant currency. Next year, the new iPhone comes in, that growth bounces back to 8 to 10%. 8 to 10% plus about 3 to 4% from buybacks. 12 to 15% in EPS growth is not shabby for any large company. You don't see that, very often, frankly.
Anurag, wonderful to get your perspective. You know that. You're one of the best. Anurag Rana there of Bloomberg Intelligence on Apple. Apple in the pre-market at the moment, positive through the whole of this morning. We're up by 2.6%. Biggest weighting, of course, on some of these major indexes here in the United States. On the S&P 500, Tom, futures positive 0.7% as we count you down to payrolls.
Yeah, we count down to there. We also count down to Naples waking up this morning. John, explain to us worldwide the Apple videos we saw last night.
Oh, so
of
cool.
Monstrous celebration in Naples, Italy.
They've come close a couple of times over the last 10 years, but finally for the first time, I think in about 33 years, you've got to go back to the 89-90 season.
Is this like when Leicester won?
Diego Maradona was a god at this football club and still is in this city, even after his passing. Just amazing to see him win the title. Terrible defense from my beloved AC Milan. Did not really stand up and try and defend this title at all. They're doing really badly in the league, I think, relative to what they should be.
But probably...
I can go on that rant another day.
No, but John, this is important. And folks, I need to get a flavor of Italian football. And the only way to do this is next Wednesday, AC Milan, Inter Milan. I mean, that's a derby.
I'm very excited. You have to remember, Tom, that my family's from the South and I ended up supporting the club from the North. But I understand the romance of a team from the South winning the Italian league and getting one over the Milan clubs and Juventus as well. This is really, really meaningful stuff to the city of Naples.
Yeah.
Congratulations, Napoli. Just absolutely fantastic. Your payrolls report, 34 minutes away. Nadia Lovely, UBS, the former Federal Reserve Governor Randy Krosner, Jeff Rosenberg of BlackRock with us to break some of this down. Looking forward to doing that in the next hour.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We are going to have more stress exhibited across the markets in the coming months.
We have all the ingredients for a new growth scare, and I think equities, certainly in the short term, are probably a bit complacent to that.
We are expecting a version of credit tightening and crunch to come through.
We think still that liquidity is the big issue.
My big fear is that we're already starting to turn from an interest rate risk story to a credit risk story.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On a Friday, we're going to step away from the banking crisis. The news here of better pricing for banks. In this hour, the labor economy of the United States of America. John, we're near full employment. You mentioned Iowa earlier, under 3% unemployment rate.
2.8 is pretty phenomenal, isn't it? For the country at the moment, the number is 3.5. We're looking for that to come up to 3.6 in our survey, at least. That's the estimate. 29 minutes away from that number. 185 is the headline estimate in our survey at the moment, 185,000. I have to tell you, though, for this bond market, it's not the data that's pushed around this bond market. It's the bank stocks that have pushed around this treasury market.
Yes.
That's been the story for the broader market. PacWest, Western Alliance, names we would never talk about a couple of years ago. They've been kicking around that 2-year and rate cut expectations for the last couple of days.
And they're kicking around to keep on that theme here, 3.83%. We'll do the data check here in a moment. But to the whisper number of what we're going to see here in 29 minutes, 28 minutes, John, is the whisper number of Goldman Sachs and others nudging up a little bit off ADP, where they really don't have confidence in ADP.
So on Monday, this market was kicked around by data, and it was the prices paid component of the ISM non-manufacturing, or rather ISM manufacturing number on Monday that moved this market, together with a bunch of debt issuance as well. If you get a sign of price pressure from wages, which I think, Lisa, is what you're leaning into, right, in about 28 minutes, that could be the thing that reignites the conversation around sticky inflation again.
Otherwise, are we just looking at what everyone says is a snooze fest, even though it's not really, because it's giving you some actual real information? This is the data for the data dependency that you've talked about some this week. How much are we looking at data that people are ignoring to pick the narrative that they want to pick? I mean, really, again, I keep going back to this because I'm old enough to remember 6 months ago when we were talking about the most important Fed meeting, the most important jobs report. No one's talking like that anymore. Everyone's like, it's not going to matter.
I'm going to take the side of the optimist here. Neil Daughter, James Glassman at J.P. Morgan, hugely optimistic on the resiliency of American consumer. And the answer here, John, is the Fed is demanding what? A 4% unemployment rate? 4.2% unemployment rate?
4.5 is that projection.
And we're quoting Iowa. I think Arkansas, when we had Congressman Hill on, is the same idea, sub 3%. I'm sorry, it's a fully employed America.
What will it take to get unemployment higher? The projection is 4.5. They also think it's going to stay around that level for the next couple of years, and a lot of people have doubts about that happening, Tom.
I have trouble with this. I'm with Senator Warren on this. Why are we battling to have unemployment higher? I'm sorry. American politics is, if I'm elected, a free beer and I'll give you a job. That's the history back 200
and Tom, the
X
fact
years.
that this conversation is so tense with unemployment at 3.5, you can only imagine what that would look like once unemployment starts climbing in a material way.
I mean, that's what we're going to see here. We're going to give you all that data. Michael McKee's in Washington, right? Help me with that.
Yeah. He is.
Data, I'm going to go to the 2-year, which I mentioned, John, 3.83%.
All over the place so far this week. Through 4%, high the week, 4.16%. The low, 3.65. Somewhere in between at the moment at 3.83. On a 10-year at the moment, yields are a little bit higher, back through 3.40. Unchanged on the euro dollar 110.12. And the equity market, Tom, with the lift up by 0.75%. 2.5%, supported by the beast that is Apple. Apple up by 2.6% in the pre-market.
Yeah, I'll give you the Apple move, but I'm sorry, 4,100 folks, SPX here is a stunning number given the bond ballet that we've seen. To get us started here on this job day with all of our good coverage, and please stay with us, Nadia Lovell leads off, Senior U.S. Equity Strategist at UBS Global. How separate is the equity market, Nadia, from the bond market as we go to the jobs report?
You know, I think that the equity market has a fair amount of optimism priced in, and a lot of that has to do with the larger companies that are really powering this index, as you have alluded to. I think that in terms of the tightened credit lending set, these companies are more directly insulated. But, you know, we still remain cautious on the outlook for the equity market. We think that some of the market internals, including the flows data, are sending some bearish signal and suggest that some of the systematic buying that we have been seeing in this market under short cover and support just isn't there anymore. And you have valuations that are extended, earnings optimisms that are more than fully priced in with an 18 times forward PE. So we just think that this market remains fragile and vulnerable, and we're looking for another 5% or so pullback from here.
Nadia, historically, do you buy or sell the last hike?
Historically, what you do is buy the last hike, because normally you will see the market rally from there. But I think that this time might be different. Like the setup is just different. You have inflation that are still high. You have now concerns within the banking system and some fragility around there. And so we think that the outcome is just going to be just different this time. We think that the economy is going to slow, and that's going to pressure earnings.
Do you care about this labor market report that we're about to get?
Yes, we care if it's negative, but it's likely to come in line with expectations or even surprise to the upside, as we've seen all this time. We think that is just less of a focus right now. The focus is going to be, as we know, next week on the Senior Loan Officer Survey, which actually we've been talking about for months. But we're also next week going to be closely watching the small business, the NFIB small business surveys, because we want to get an indication of what small businesses are experiencing. We know that they're the ones that you're seeing the larger labor demand, and are they seeing any slowdown in sort of the expectations going forward?
So is this about the fear that has been really imbued in the banking market? Is this basically this concept that there is this pernicious credit tightening that we just don't see yet, that has a lag effect, that's going to drive all action in upcoming months, and everything that you've seen until now could be potentially a head fake? Is that basically your thesis?
You know, our thesis, like we've been pointing out tightened credit lending standards for quite some time as to why we had expected negative earnings growth this year, because there's such a strong correlation. So we think that there's going to be further tightening. You know, reality is like the banking system is safe and sound for depositors, but there still might be some concerns and around profitability. We think that it's not safe and sound for profitability investors, and you're going to see the banks pull back and hoard cash, and that's going to lead to lower loan growth and therefore probably a slower economic demand going forward.
So Nadia, you wouldn't buy the banks right now?
No, we are still underweight on banks. We have been underweight for quite some time. We just think that you're having this negative feedback loop within the system right now. You have the shorts pressing, stock prices are falling. That's leading to confidence being shaken and additional outflows. But it's more than about outflows, deposit outflows. It's also about just higher deposit costs. It's also about like low loan growth and capital return. So you have the earnings risk, the cyclical risk. But, you know, John, I would say that doesn't mean that, you know, it's not investable. We just think that it's still too early. And we do think that you want to focus on the higher quality banks that have higher CET1 capital ratios that already account and mark to market some of those available for sales securities.
What is the headline that you would need to see across the Bloomberg terminal, a policy shift, if you will, that would encourage you to buy some of these names?
In terms of banks, I think what you want to see in terms of, you know, private market really step up, and also some deals that are not federally assisted. You know, you've seen all the deals so far in the last three banks have been as a result of receivership and better deals. And so you want to start to see that not happen. You also want to see probably more an explicit guarantee of deposit to help cause some stabilization within the system.
Always really thoughtful. Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management, going into the jobs number. 22 minutes from now, Tom. 21 minutes away.
And as Lisa mentioned, snooze fest maybe is a little harsh, but you're there. You're right. We've just sort of slipped into it with all the exhausting distractions of the week, including, frankly, the Fed show. And, I look at this and I just got to say, are we setting ourselves up? Remember when we came out, it's going to be 100 and blah, 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 200, blah, blah. It came out 500,000.
I think that's an impression of me. I think that's an impression of me.
All right, carry on. Yes. What was
No, I just think I don't have any guesstimate here on what we're going to see other than maybe it's time for a big surprise.
Well, to me, it's interesting that traders really didn't respond that much to a Fed meeting. They're not expecting to respond
and
that
the press
much.
Conference.
Or the press conference. Yeah. They're not expecting to respond particularly to this labor market report. Literally everything is hinging on the senior loan officer opinion survey that comes out next week. And to me, this really highlights the fear of banking stress overcoming everything else.
Haven't we got a strong indication of what that's going to look like already?
Which is also not going to necessarily move markets. So where are we?
Where are we? Can we digress?
Please do, yeah.
It's an emotional moment.
Not that you need anyone's permission.
Team surveillance. John, Lisa, and I were tearing up over the celebration of our team and a wonderful child. Well-mannered, pre-tuition. Preschool in Manhattan is $20,400.
What are we doing?
It is a birthday. Pineapple is one. And here we are this morning. We say congratulations to Rachel and all celebrating that Pineapple is one today.
I don't know what you want me to say.
$20,400 for preschool tuition in Manhattan.
Okay.
I didn't pay $20,400.
Is Pineapple actually that baby's name?
Yeah, Pineapple's her name. Yeah, I was kidding.
Why
it was a hell of a Harvey Wallbanger.
Why do I think he's getting us into trouble here?
Her name is not.
Lisa,
it's not Pineapple.
$20,400 for preschool tuition. That is insane.
Is
that how much it costs?
That's what it costs at a fancy Manhattan school, which insane. Is Pineapple's destined. I mean,
that's nuts.
There's no other way out.
You should share what you're about to do, in future.
Oh, no, it's better if we don't share it. This is important. No, people say, is this rehearsed?
You set this stuff up in the control room. The control room never tells us, and no one knows this is happening.
And just to be clear, Tom, no one asks whether this is rehearsed. I think it's quite clear that everybody knows that it's not.
No, that was what we did right from the start with Ken Pruitt and, back with David Gore. Bring up the photo of Pineapple again as we go to Jobs Day. I mean,
was this where you were going with youth employment?
I just got a message from a Bloomberg subscriber. Take that dang tang away from it. That's how that reads. And a happy birthday to anyone celebrating a birthday right now.
Including a pineapple.
Coming up, the former Fed Governor Randy Kroszner, your payrolls report, 20 minutes away.
What's in that tang. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, a few minutes from now, the U.S. jobs report may show the resilience of the labor market. April's report is expected to show that employers added 185,000 jobs and that the unemployment report ticked up 3.6%. That's only 0.2 of a percentage point off the 54-year-old record. The jobs report, of course, like we said, coming up just under 15 minutes from now. Stay tuned. U.S. regulators plan to make the biggest banks pay most of the bill when it comes to replenishing the government's deposit insurance fund. Now, Bloomberg's learned that small lenders won't have to kick in extra money. The insurance fund was depleted by the failures of Silicon Valley Bank and Signature Bank. President Biden reportedly will name the Air Force's top general to become the chairman of the Joint Chief of Staff. That's according to the New York Times. And General Charles Brown, the Air Force Chief of Staff, would become only the second black man to serve as chairman. Colin Powell was chairman under Presidents Clinton and George H.W. Bush. The co-founder of Oaktree Capital, Howard Marks, reportedly will undergo surgery for throat cancer. According to the Financial Times, Mark wrote to his investors that the type of cancer he has is curable, and he hopes to return to work around midsummer. Oaktree had about $172 billion of assets under management at the end of March. And Warner Brothers Discovery reported a surprise profit in streaming TV, but the panel of HBO and CNN saw its legacy cable networks continue to lose advertising and viewers. The company will relaunch its streaming service as Max on May 23rd. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg.
If you get a weaker number, I think the market's already on sort of what we're calling a recession alert. So that recession alert starts to flash a lot more if the data is weaker. But I would highlight anything above 85, 90,000 is actually above trend. So I think it just tells you how difficult the situation is for the Fed and the market that's hoping for some Fed relief here for a quick Fed cut. That's not happening.
Priya Misra, fantastic, always is, joining us from TD in the last hour. Looking ahead to payrolls about 14 minutes away, looking for a number that might look something like this. 185,000 is the median estimate in our survey for the month of April. The previous month was 236,000. Going into it, here's the price action for you on the S&P 500. We've been positive all morning. We're positive by 0.7% on the S&P, helped out, no doubt, by Apple. Apple is positive in early trading by 2.4%. In the bond market, yields just a little bit higher by 3 basis points on a 2-year, 382, on a 10-year up 2 basis points to just short of 340 at 339, Tom.
Very good. It is a different jobs day. We are all colored by some form of banking battle, crisis, however you want to phrase it. And as we do at Bloomberg Surveillance, we try to bring you people measured and deeply experienced. Today we do something different on Jobs Day. Joining us, truly the nation's expert on regulation. He is Randall Krosner out of Brown, an incredibly distinguished resume of thinking about our banking system, finance, into our overall economics. He is at the Booth School, Chicago, and a former Fed governor. Randy, I've been dying to talk to you about this. I don't want to do the historical, is it 08 or that? How do we extricate ourselves from a mess which was based on the rate of change of interest rates instituted by Jerome Powell?
So I think we've got to look really carefully at what's going on at the individual bank balance sheets. Some of these issues have been really obviously there. There are even some medium-sized banks that touted how brilliant they were by buying long-term securities, and that allowed them to earn a little bit extra and even raise dividends. Well, some of those have not survived and not done so well going forward. So I think that's really the next step. The immediate next step is looking very carefully where the issues are, and also really just identifying the ones that are vulnerable and the ones that are not. Right now, there seems to be a lot of spreading of concerns across a lot of institutions, some of which are stronger, some of which are weaker. Focus on the ones that are weak, deal with those, and then move on.
Should we allow for combinations of 4,000 banks? Is this enough of a shock to finally, once and for all, move us away from the, not paranoia, but the debate wrapped around Andrew Jackson?
So, until relatively recently, we had 15,000 banks, then we came down to 5,000 banks. And the U.S. is really an outlier in having that many banks relative to the size of the economy. Now, the small and medium-sized banks do something different than the large banks. A lot of the local commercial real estate lending, the big banks don't seem to have much of an appetite for that and don't seem to be too eager to get into that. So I think there is value in having some variety across the types of institutions. Do we need exactly 5,000? I'm not so sure about that.
Randy, we're about 10 minutes away from the latest labor market report, and we're talking about banks, and that's really telling at a time when a lot of people are trying to look past this number and just figure out what the lending sentiment is, what the credit impulse is across this nation. From your vantage point, do you think that that is dangerous to sort of discount the strength in the labor market for potential sentiment in the banking sector?
I think it's important to be very much aware of what's going on, because those, the 4,900 of the 5,000 banks that we have are very important for small and medium-sized business, and a lot of jobs are generated there. So I think there's a close link between the two. But obviously, the jobs report is going to be extraordinarily important for thinking about where the Fed is going to be going. Although I think it's highly unlikely that the Fed is going to be cutting unless there's some sort of crisis that occurs. But it is going to tell you something about the likely path of inflation and of where the Fed's going.
What's the crisis that would cause some sort of response like that? What's the level of crisis, especially if this labor market is as strong as it's expected to be?
Well, I think the tumult could come from some different sources. One could be geopolitical. My goodness, we're in a really difficult geopolitical world right now, whether it's Ukraine, whether it is China, whether it's the Middle East or Africa. I mean, either cold wars, hot wars, or wars that might be building up even further. So I think that's one worry that could come. And obviously, if there's major financial turmoil, the Fed will respond, but it has to be, I think, pretty major. It's not just a couple of banks here and there. Obviously, the Fed was willing to raise rates despite the tumult over the last couple of months. And so just something like what we're seeing now is not going to be enough to get the Fed to move.
Randy, you are the distillate from George Stigler, on Frank Knight, I can even say, to George Stigler, and on to what Stigler did, which was the capture of the system in regulation. Senator Warren is fired up. James Dimon is a piñata as he takes out bankrupt banks, essentially, in all. Have the rich guys captured the system as George Stigler studied?
Well, that's something that we debate very much here at University of Chicago on exactly how to apply George's insights. And so I think, obviously, special interests do play a role, but also sometimes positive, sometimes negative. We also see that it was the least cost resolution for JP Morgan Chase to take over First Republic. And the Federal Deposit Insurance Corporation Improvement Act of 1991 requires that the FDIC take the lowest cost bid. They really had no choice in that, and JP Morgan Chase was able to make the lowest cost bid. So there are pluses and there are minuses. I think we do need to think about how we want to reshape the system going forward. And that might mean not just changing regulation, but also changing some of the laws that would be up to Congress and for Senator Warren to potentially change.
If you are just tuning in, welcome to the program. We are about 7 minutes away from the payrolls report. The estimate 185 this morning, 185,000. Lucky to have Randy Krosner with us. He'll be with us as we break down the number in about 7 minutes' time as well. Mike McKee's down in Washington, D.C. He'll give you all the numbers you need when this number rolls out. Mike McKee, here's a question for you. When was the last time that payrolls came in below estimates?
But 13 months ago, actually, in March of 2022, which coincidentally was when the Fed started raising its interest rates. But it has been a very long string. We'll see if that continues today. If it does, and actually the whisper number in the markets is 190, so Wall Street is leaning towards another beat that way. If it does, it may put paid to the idea that we're going to see a rate cut in July. To get to the Fed's forecast for unemployment of 4.4% by the end of the year, we're going to have to start seeing some big negative numbers in job creation soon. If not, that's not going to happen.
Mike, very quickly here, how did ADP and claims adjust the whisper and the guesstimates of this moment?
Well, maybe ADP has influenced the whisper number, hasn't influenced too much the overall number. Some people did recalibrate their forecast, but for the most part, we've been in the 180 to 185 camp for a couple of weeks in terms of economic forecasts. People looking for a slight deceleration in job growth. We'll see if we get it.
Mike McKee, thank you. Of course, Mike McKee knew the answer to that. It was the March jobs report released in April, we were looking for 490,000 and we got 431. They were the days, weren't they? Lots of numbers like that. That was the last time that payrolls came in below estimates on the day. Isn't that phenomenal?
It's phenomenal that people have underestimated this economy to such a degree, and that now people are saying that actually, even if we underestimate it this time, the lag effects are going to take care of that.
To that extent, I went back and looked at where we were on unemployment at the peak, which was, I believe, February, March of 2020, and it was 150 million statistic. And John, we're back to that. Now we've got immigration, we've got, a larger economy over 3-4 years. We forget how long it is back. But we've essentially recovered in a general way to where we were in 2019.
It's taken this long to get back to normal, whatever normal is.
Yeah, and I think that's the hedge that you got to make. There's a lot of moving parts going. What a privilege to have Governor Krosner on that. We'll talk jobs with him here.
Very cool. He's going to stick around. Mike McKee's going to stay close down in Washington, D.C. He'll break down this number for you in about 4 minutes' time. Going into payrolls, 185,000 is the estimate in our survey. The previous number, 236. The actual number drops next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The payrolls report are literally seconds away. In our survey, the median estimate 185,000. The number drops in about 15 seconds. The price action going into it, near session highs on the equity market, positive 0.7% on the S&P. Bond yields are a little bit higher, up 2 or 3 basis points on a 10-year, back through 340. Your yield, 340 at the moment. With a jobs report, here's Mike McKee.
All right, John, let's take a look at what we get here, and we do it again. You're the winner, John Farrow. For the 13th month in a row, jobs come in above what was forecast in the Bloomberg survey, 253,000. The survey, as you mentioned, 185,000. Even more significant, check this out, 3.4% unemployment. Wow. The unemployment rate drops by another tenth to 3.4%, was expected to go to 3.6. We have a revision of 149,000 jobs subtracted from February and March. So take that out of the 253 in terms of total number of jobs, and it does show a little more weakness in the job market than we had seen, but on a month-over-month initial report basis, very strong today. Manufacturing jobs up 11,000. Remember, ADP had said we'd lost 38,000, so manufacturing not in as bad a shape as anticipated. Average hourly earnings, Lisa, this is for you, we're up 0.5% on the month, which was much stronger than the 0.3 we saw last month and the 0.3 expected. And that pushes the number up from 4.2 on a year-over-year basis to 4.4%. Average weekly hours, 34.4, unchanged. And the labor force participation rate unchanged at 62.6. So I'll let you check the markets, and I'm sure we have some sort of reaction to that, John, while I dig into where the jobs were created.
We'll take a guess, Mike. Stick that in your bond market. Yields higher by 10 basis points at the front end, 390 on a 2-year right now. Off the back of that, as you might expect, yields up, dollar stronger. Euro dollar, Bramo, guess where that is now?
110.
A break of 110. Woof. 109 now. There's
no
some
way.
news. We're negative 0.2% on that currency pair. Equity's just about holding in there. Session highs going into the print, still there and thereabouts, positive 0.6%. But TK, that is a beat on the top line, the headline number, an upside surprise. We still haven't had a miss on a jobs report going all the way back to the March report of April last year. TK, wages hotter, unemployment lower. It's a beat on a headline number.
I'm going to channel Joe Biden here and go 3.4%. To me, that's, you know, I haven't even had time to go below the data. I'm looking at the state numbers right now and the actual numbers for Iowa and the rest, John. But the answer here is 3.4% is miles from where the chairman of the Fed wants to be.
If you're wondering why the market isn't reacting more, because 10 basis points of a move is basically little change these days in Treasuries, just based on how much they've been whipsawed, take a look at the revision. The downward revision in the prior month in the change. And this, to me, is really the question, and the upward change, frankly, in payrolls. Are we looking at something that is moving in a way where you can confirm your narrative? I mean, again, which is the reason why perhaps markets aren't moving as much as you'd otherwise expect.
3.4% unemployment, wages hot. To Tom's point, that's not the picture, Tom, that the Fed chair, Jay Powell, thought he'd be looking at 12 months ago when they went from 0 and started hiking interest rates.
Can we just have a moment of silence for the optimists out there? And we've all got our names that we know, but I'm sorry, how far are we from a recession? And granted, it's lagging data, I get all that. But this is a re-election unemployment report for Joe Biden. This is really good math.
I don't
even
want to get
revision.
over my skis 18 months out. I've got no idea what things look like next week in a financial system, never mind next year in the economy. But the fact of the matter is this. We've gone from 0 through 5, Lisa, on Fed funds, and unemployment is still at 3.4%. The Federal Reserve is projecting something in and around 4.5% by year end. Let's see if we start to see that develop through the summer. At the moment, Mike McKee, you're not seeing that develop at all. On the headline number, to Lisa's point though, Mike, can you just jump in on the slowing jobs growth, whether the trend is there for us to get our hands around now?
There doesn't appear to be a trend in there, although what we seem to be doing is flattening out, because we're looking at kind of the same numbers over the last couple of months. We had 253, and we had basically 236 last month. Now that's revised down to 165, but 248 in February. So we're looking at kind of a flat number, but it's still the same number of a healthy gain. Even 146, you go back to the March number, the revised March number, that would be stronger than we need to absorb all the workers coming into the labor force. Taking a look at the unemployment report, too, we see another big month for jobs. The number of people employed grew by 139,000, while the number unemployed fell by 182,000. The labor force fell by 43,000, so a lot of that was people dropping out of the labor force, but still we're seeing in both the establishment and the household survey a big gain in employment and unemployment falling. It's still a very strong labor market, although to give Lisa her due here, we are seeing a drop in the average basically for all of the categories that have added a lot. Leisure and hospitality was up 31,000, but they had been rising at a rate of about 71,000 for the 73,000 for the past month over the prior 6 months. So we're seeing a drop in the additions, but we're seeing a broader group of employment categories add jobs.
Shout out to Jan Hatzius and the team over at Goldman as well.
Home run.
We're looking for something in and around 250. We've got 253. Mike, thanks for that, buddy. As always, just one of the best, in fact, the best, breaking this stuff down. Headline beat then, 253. The estimate, 185. Lisa, right to indicate that some of the revisions aren't fantastic, but ultimately 253 against 185. Unemployment drops to 3.4%. We were looking for 3.6. It moves in the other direction, lower. Wages come in hot, month on month, 0.5, year over year, 4.4. Pushed you through the market. Equity still firmer, positive 0.6%. Yields higher at the front end by 8 basis points, 387. As we pointed out a few times this morning, the banks have been in the driving seat for the bond market this week, not the economic data. And a finish on foreign exchange, the euro, negative 0.25%, 109.83. Coming up in the next hour, Mike Collins of PGIM, fixed income, Anastasia Amoroso of iCapital. We'll catch up with Rick Reeder of BlackRock, Dan Ives of Wedbush on Apple. Apple up in a pre-market following earnings, Tom.
10-year real yield advances as well in the constructive report. The 3-month averages here is published in the report go from 524,000 to 320,000 to 295,000 to 222. With us, Randy Krosner of Booth School. Randy, there's a trend of the smooth 3-month moving average. I'm acting very PhD at the Eccles building. This is a very gradual trend to where Chairman Powell wants to get to. Does he have the time to wait for that trend to play out to something that's a lower statistic?
I think you really nailed it. That's the challenge. Now it's moving in the direction that they wanted to move. Finally, it's taken a long time to get there. Now, as I've mentioned before, what they're hoping for is this immaculate disinflation, where you just slowly weaken the labor market. Unemployment rate only goes up to about 4.5%, which is not far from what they think of as the long run average, and the inflation rate comes down. Now, the hot number on wages is really not consistent with that. We're going to be getting another labor market report before the Fed makes its next decision. We'll be getting a lot more inflation data that's coming in. But as I said on this program before, the Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
How do you understand the average hourly earnings and how much they've gone up? I mean, given the fact that people were saying that we're starting to see this process where suddenly workers are losing some of the power that they gained in the immediate aftermath of the pandemic, does this fly in the face of that and really confirm that perhaps we're in a different environment with a smaller workforce and perhaps a greater sort of thrust to labor's power?
Sure. So labor force participation is really key to that, and Mike had mentioned that. That's one of the challenges that the Fed has had. You've got this lower labor force participation. You've got demand being continued to be very strong. Some of that had been from fiscal stimulus from before, but continuing on with fairly strong demand. And tight labor market means really one thing, which is wages are going to go up. Fortunately, the hope is that they won't go up quite as fast going forward, but that's really that so far the data are not telling us that.
Randy Krosner, thank you so much. Particularly, Professor, thank you so much for your comments on our troubled banks here in the previous half hour. He is at the Booth School, Chicago. What a joy and really a sign of COVID moving away and we're getting back to our normal lives. Joining us in studio, Jeffrey Rosenberg of BlackRock, of course, portfolio manager, systematic multi-strategy fund. Great to see you.
Good to see you. Good to be here.
This is our work from office, okay? It's great to have you here as well. Your being here, is it a symbol of this job economy and maybe even of this troubled banking crisis that we're somehow getting back to normal?
Well, we are getting back to normal in terms of the COVID part. I think when you look at today's report, as you guys have already covered, this is not getting back to the slowing that the bond market is expecting, that the Fed is hoping for, that's going to really bring down. Mike McKee said something at the beginning, which I want to echo, which is we're very far away from what these job market reports need to start to look like to begin to even get close to what the Fed is forecasting.
Okay, I think the pros know that we need to get down to 120, 100, even 85, whatever, maybe a couple negative statistics as some have called for in a presumed slowdown. But what's the unemployment rate that makes Chairman Powell sit up straight?
Well, it's one that starts to rise. He said it in...
It's a vector. It's not so much the level.
It's the change that has to start showing the tightness in the labor market, or the tightness of the labor market beginning to ease, and getting some increases in the unemployment rate. He said it in the press conference that, part of what is the price to pay for achieving success on inflation is a rate of growth that is for a small period of time or a temporary period of time below trend. Well, that's what it'll start to look like in the labor report in a rising unemployment rate, and nothing in this report really points to any of that.
So do you think that the market is overpricing the boogeyman of some sort of crisis or cracks or something to sort of cause this to halt in its tracks and reverse in some sort of meaningful way?
So let's separate the market pricing of what is a boogeyman. I think the market worries about tail risk, shock events, crises, and look, the banking sector crisis that we saw in March and a little bit of a echo rebound that we've seen this week is that kind of thing. But that's very different than kind of fundamental economic performance, and that's not so much a tail risk. That's really much more about the trajectory. Now, the two can be linked, obviously, because if you have a crisis, that feeds back into confidence, and that is the economy.
But this creates a real issue, and I'm wondering why we're not seeing it, frankly, in longer-term Treasury yields a little bit more, and whether this is something you're thinking about. Because if you have this push-pull, and perhaps the Fed not being as aggressive as people thought that they would be, just based on the economic projection, then isn't the risk of inflation remaining high for a longer period of time that much greater and not being priced in?
Yeah, and it's the pricing in of that should be the term premium, right? There should be a premium for holding longer dated maturities because you have more inflation risk and inflation uncertainty, and that's the disconnect here. The market is really wedded to this view that we go very rapidly back down to a pre-COVID 2% inflation rate. And today's data is just kind of another piece of evidence that says that's not what we're really seeing in the economy yet. So the disconnect between what the Fed has been saying, what Powell said earlier this week in terms of a lot more cautionary tale relative to what you see in the yield curve, the inversion, the lack of a term premium that your question was just asking about, that's very much still the tension that we're dealing with.
At Tepper, Carnegie Mellon, you had Alan Meltzer, Marvin Goodfriend, and the ginormous Bennett McCollum, who we lost late last year at 87 years old. And they hearken to what some people are looking at now, which is M2 exploding with the Biden stimulus and M2 coming out. For BlackRock, how disruptive is this huge variability of M2 and now signaling a real, almost like thick oil within the system? The engine oil is getting thicker and thicker, isn't it?
Yeah, it's a huge deal in terms of the structure of interest rates, of monetary policy. We went from a restrictive reserve system to an excess reserve system, to a plentiful reserve system. And you've seen that in the banking statistics, for example, in terms of loan to deposit ratios. Part of the increase in uninsured deposits, that is kind of part of the source of what we saw.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence, it's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Inflation rate. What data are you looking at? If it's not the labor market report, if it's not what the Fed said this week, this all doesn't seem to matter anymore as people just sort of hunker down with their narratives.
So couple of data points. So let's come back to your favorite data point, average hourly earnings in this report, and 0.5. And why that one is a hard one to anchor on is because it's so subjective. It's so sensitive to the mix shift. So part of what you saw in the internals of today's labor report is a little bit less boost from leisure and hospitality, a little bit more spread. Those tend to be small, lower income changes. So when that mix shifts, that helps to boost. That's not giving us a good picture of inflation and wage inflation. That's just changing the mixture of what is in that component. Last week's ECI, a much better measure. Atlanta Fed wage tracker, much better measure. And next week, we'll look at core services, ex-housing, as the kind of mapping to the labor market and the more stable long-run indicator of where is inflation going to settle down. No one doubts that peak inflation has occurred, inflation is declining, the shelter piece is going to decline and help push everything down. It's about, do we get to 2% the way the bond market expects, or do we maybe get to 3%, and because of this wage dynamic, you end up having a lot harder time, and the debate shifts to the cost of getting to 2 versus 3 versus the benefits.
In the here and now, historically, how hard is it to get to recession with a labor market report like what we just got?
That's a 3.4% unemployment rate. Now, yes, it's a lagging indicator, and we get that. But again, what Powell said earlier this week is a little bit of surprise that with 500 basis points of tightening, you haven't really seen that much slowing. And, you look at earnings and what the companies are saying. You look at what credit markets are saying, high yield spreads, investment grade spreads, away from the banking sector, of course. And this is still a very robust economy, so the tightening is yet to show up. We expect it to show up, but it hasn't yet. And
he said that 8 months ago, too, as well,
but
on the jobs report.
That's the shocking thing, is that people were talking about the lag effects. Some people saying it's 18 months now, 12 to 18 months, but it is a serious thing, especially given the fastest pace of tightening going back to
go from Randy Crosden to Jeff Rosenberg is wonderful. Jeff, thank you so much, particularly for those thoughts on Bennett McCollum and Carnegie Mellon. Futures up almost a stick, 34% on SPX. Dow futures up 228, maybe off the angst of yesterday. The VIX at NYSE 18.41 shows you where the equity market is. Now in the bond market with 2-year yield up 7 basis points, 3.86. He's great. He's aged this week. Ira Jersey joins us, chief U.S. rate strategist for Bloomberg Intelligence. Ira, what are your team going to write about to get ready on the Bloomberg terminal Monday morning? Forget about the jobs report. What are you going to write about within this crazy week to reframe Monday morning?
Yeah, I'm actually writing about today the what Jeff Rosenberg was just talking about with some of the reset with the banks and the RRP facility, with the Federal Reserve increasing interest rates this week. It just makes money market mutual funds even more interesting for investors to move money out of banks that have low deposit rates up to money funds, and that could have knock-on effects to a lot of different pieces of the market structure.
On the BTMM screen, or for our listeners and viewers on a more general basis, what is the thing to watch to begin to see if money market funds, dare I say, nudge towards 6%?
Yeah, so I would be looking at the SOFR futures and what the December SOFR futures are looking like. And when you get a data report like this, then there still is a non-zero chance, right? There's actually a growing chance that the Federal Reserve will feel like they have to act again in order to try to get inflation lower. Now we don't think that that's likely to happen. I think that what Chair Powell, I think what he needs to do in order to kind of fulfill both of his mandates and also make sure that there's some semblance of financial stability is to try and convince the markets that they're not going to be cutting this year. He keeps on saying it, but the market doesn't believe him. And if you think about the idea that if the Federal Reserve could convince markets that they're not going to be cutting rates for, say, a year, that's almost like building in 2 more hikes, because the market is already pricing for a late this year and then early 2024 interest rate cuts. So you know, a lack of cuts is as good as a hike at this point, I think, in the cycle, and it's going to take a lot of jawboning for the Fed chair and others to convince the markets that that's going to be their policy path.
Perhaps because of exactly what you started on, Ira, the attractiveness of short-term paper, the idea that you could get yield now putting into bonds, and this idea, I really can't get over this number, that money market funds attracted $588 billion in new funds over the past 10 weeks. That is more than what we saw in the aftermath of the Lehman crisis. From your perspective, have we hit that tipping point where these flows start to accelerate and start to matter in a more significant way than they did, say, 6 months ago, when people hadn't fully woken up to the yield that was available?
Well, I don't know if they accelerate, but I think that they can continue, and that's not great for some banks unless they increase their deposit rates, and of course that means that net interest margins contract pretty significantly. You know, importantly, and this was, again, goes to something that Jeffrey was just talking about, is that it's almost impossible it would be right now impossible for money market funds to accept all of these flows without T-bill yields being significantly lower than where they are, 1%, 1.5% lower than where they are today, except that that these money funds can put their money at the Fed's RRP facility, at the reverse repo facility. If that facility didn't exist, the whole entire money market structure would be way different than it is today. So there's a challenge that the Fed has in, you know, trying to keep interest rates high, but at the same time ensuring financial stability. And I'm not sure that they're doing a great job with that right now. It's because, you know, we have all of these unintended consequences of what the Federal Reserve's past policy is doing to policy today. I think that there's going to be a challenge, and the Fed has to, I think, do a lot more work and think about how their future actions are going to affect the financial sector as a whole.
Ira Jersey, Lisa, is a grizzled pro, and what he just said there about the conundrum at the Fed on stuff I really don't understand. I'm not expert on this, as Mr. Jersey is. There's no other topic. When does the punch bowl, you know, talk about the punch bowl, when does the punch bowl get taken away from a 5% yield and normalized back in a simplistic way? That's the debate, and Ira just addressed it into this weekend. What do they do this weekend on it?
Well, and Ira, to that point, have you been surprised that we haven't seen even more cracks based on how quickly the Fed raised rates and how interest rate sensitive people used to think this economy was?
Well, what's interesting is that the other piece of the Fed hiking and why some of the larger banks, right, the systemically important banks, they've actually benefited from some of the, you know, relatively new facilities like interest being paid on reserves. Because if you hold a lot of reserves, like those large systemically important banks do, they're getting paid now over 5% for holding those reserves. Right. And at the same time, even with an inverted curve, it's not affecting their net interest margin. In fact, it's actually helping their net interest margins. And when you look at the aggregate data, it makes the banking sector look okay. But of course, there's a distributional problem with that. It's that the big banks are getting bigger and are benefiting from some of these. The small and more regional banks are not. And I think that's the difference in this crisis versus say 2007, 2008.
All right, Jersey, thank you so much, folks. You can rehear that the clinic given by Mr. Jersey and frankly Mr. Rosenberg out on YouTube, where we're building out the franchise as well. Futures up 32, Dow futures up 215, a 4,100 level on SPX, which means it's time to speak to Gina Martin-Adams about a fully employed America. It's a jobs report, Gina. 3.4% as well. That keeps consumption going. Are consumer stocks attractive?
Look, I think in our sector scorecard, consumer discretionary actually did pop toward the top of the sector scorecard on the idea that inflation is slowing, not necessarily on the idea that the consumer is going to accelerate. We're weakened materially by high inflation, high input costs, and a troubled inventory cycle. And now a lot of those risks will clear into 2023, which will allow for the consumer discretionary stocks in the S&P 500 to perform quite a bit better on an earnings basis. So it's less about demand, which I think anyone reasonable would suggest that, as we move forward and we absorb the higher cost of funds and the higher cost of borrowing, the consumer growth sort of story will slow a little bit. But it is really about margins. We've been talking about this ad nauseum for the last 2 years, but I'll just, at the risk of repeating myself, suggest that this is a story of inflation really impacting the equity market. It's not yet about growth, and until the evidence suggests it's about growth, the equity market will trade on the inflation story more than anything.
Gina, we're talking about job creation and the fact that it's come in for a 14th consecutive month higher than the expectation on Wall Street. From your vantage point, can you pair the anecdotal reports that we hear in earnings of layoffs with this job creation machine that just keeps going?
I think it's really about industry, Lisa.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Limes.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus. And Bill Belichick sees him and cuts him on the spot. In many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Another payrolls beat. Live from New York City this morning. Good morning, good morning. Your equity market positive 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the latest payrolls report coming in hot. Bruised regional banks looking to get to the weekend, and the iPhone bouncing back, helping Apple top estimates. We begin with the big issue, payrolls in America.
The jobs report, payrolls.
The actual payrolls number, this is not a quitting labor market.
The unemployment rate is still at a multi-decade low.
And wages are the key here. Wages are still too high.
Some tantalizing evidence of wage growth coming off the boil.
A little bit of deceleration in payroll wages.
But that just wasn't corroborated with what we saw in the employment cost index.
If you have this wage pressure,
they're not consistent with a 2% inflation target.
Those higher wages get passed into higher prices, and you still have an issue with inflation.
We've been expecting a slowdown for really the past 6 months. As the chairman noted,
you've still got a decent strength in the labor market.
So far, the data are not telling us that.
The labor market in the U.S. is still very tight.
Mike McKee on the story down in D.C. Mike, not bad, not bad.
Yeah, oops, we did it again. 13 months in a row where the jobs number comes in higher than the forecast from the economists that we surveyed, 253,000 in the month of April. Now, the nuance here, or the slightly bad news, is we saw big revisions down of over 70,000 in each month in March and February, so a total of 149,000 fewer jobs in those months. But look at the unemployment rate, 3.4%. That is a multi-decade low, back to it, partly because the labor force shrank, but a lot fewer people were unemployed than employed. Participation rate doesn't change, and we saw a tick up in the prime age participation rate, which is something that the Fed wanted to see. And average hourly earnings, you can play around or flat, 0.5 for the month, 4.4% on a year-over-year basis. Some say that is inflationary, some say that's not. Taking a look at where the jobs are and aren't, professional services gained 43,000, but temporary services lost 23,000. So not clear if that's a signal or not. Leisure and hospitality, 31,000. They had been gaining 78,000 a month on average over the last 6 months. So basically this shows a slowdown. Although manufacturing and construction were expected to drop, they did not. And one more quick look, John, at the average hourly earnings situation. Is it inflationary? Is it not? Lisa was thinking it might be. You take a look at the range in which people at the Fed think you can sustain 2% inflation, and we're still well above that. So whatever you think of average hourly earnings as an indicator, it does suggest there are still some inflationary pressures out there.
Mike, thank you. We'll try and touch base with you again later this hour. The jobs market, again, looking resilient. Joining us now to discuss, I'm pleased to say, Mohammed Al-Erin of Queen's College, Cambridge, alongside BlackRock's Rick Reeder. Mohammed, first of all to you, this labour market looks pretty resilient, doesn't it?
Oh, it is amazing. And just think of the following three things. On the one hand, we beat across the board: job creation, wage growth, labor participation force, and also the unemployment rate. That's the good news. Now, even when you adjust for the revisions, as Mike said, 149,000, we still beat across the board on the other three things. So it is good news for an economy that's trying to avoid a recession, but it makes the Fed's trilemma even harder.
Rick, is this good news?
So, so first of all, the stories that we're going into recession, deep recession,
Well, I'm not sure I buy into that. I mean, think about where consumption is, where income is, where employment is. It's ambiguous to me as to whether whether we're going to go into recession. But I would say one thing though: we are slowing, and I think if you actually parse these numbers a bit, and you look at the goods employment, and look at the 3-month moving average, 6-month moving average, 12-month, you're clearly slowing. The cyclical nature of this report, the goods employment is clearly slowing. Temporary hiring, as Mike said, that's clearly slowing. That's an indicator of what the forward's going to look like. And the last one, you look at leisure and hospitality, that's coming down. That's a cyclical one. Where's the big nut of where the jobs are? Healthcare and education. Those are not cyclical. Teachers, nurses, et cetera, they're not interest rate sensitive, they're not cyclical. If you're the Fed and you're parsing this data and you say, okay, what's happening to the cyclical influences? And by the way, we saw this in all the earnings reports. The industrial is slowing, retailing is slowing. The cyclical is slowing down. And I think the T+1, when you analyze this report, will suggest cyclical momentum down. And that to me is a real takeaway from a number that without question is solid. And the backdrop is solid, which questions the deep recession story for sure.
So let's fold in the banking story as well. Mohammed, you touched on this, you alluded to it. How much of a conflict is there right now between monetary policy objectives and financial stability?
So pick up on what Rick correctly said. What we're seeing is that the service sector more generally is the engine of growth right now. And that's important because like him, I've argued for a long time, we don't necessarily have a recession in our future. We can avoid it. But it makes the job of the Fed more difficult because that's the sector that, as Rick correctly said, is less sensitive to interest rates. So the Fed has one of two choices, either to go after that source of inflation as it sees it through higher interest rates and therefore risk financial stability, and we've already got fragility in the financial system, or try to somehow tolerate higher inflation because it is concerned about that third leg of the trilemma. John, the problem all of us have is this Fed is very hard to predict. So I have no idea what they're going to go for because there haven't been that's consistent over time.
These bank stocks have been very hard to predict. Let's pick out two of them. PacWest, Western Alliance. PacWest right now in the pre-market up by 34% or so. Western Alliance trying to bounce back as well, up by more than 30%. Rick, two questions for you. Can the US economy live with 5% rates? 1. 2, can the US banking system live with 5% rates? And is the answer to both those questions the same or different?
It's different. So U.S. economy is incredibly resilient, and the shift to the U.S. economy, like Mohammed said, we've moved to a more service-oriented economy. By the way, service-oriented economy is much less interest-sensitive, and you can see this when you break down this jobs report. Much less interest-sensitive. By the way, you look at CapEx in this country. It goes to information processing. It goes to AI. It doesn't go through to hard asset like it used to, which is interest rate sensitive. I think the thing that is really important, and I think for the Fed is really important, we've moved to a very restrictive level. Financial transmission is being tangibly impacted. Capital, you think about how the financial system works. You have asset and liabilities, and what's left over is capital. When you hurt the assets, when you bludgeon the assets and the cost of your liabilities go up, you really damage capital. So financial transmission will slow significantly. Credit contraction will follow. Listen, I think the U.S. economy is going to slow. I just don't think when you have a different economy than we've had in the past, I'm just not sure we're going to a deep recession for sure. Could you have a small recession? Maybe. But I think we got to be really careful. I think the Fed's got to be really careful because you don't want to damage residential real estate. There's a slowdown in activity. That's where a lot of the equity in the country is. And you got to be really careful about not going too far to damage that. We've certainly impacted commercial real estate, but residential is 4 to 5 times bigger, and it's where you hit the core of the economy versus commercial real estate, where the equity is held in commercial real estate is different than when the core of the economy is in residential.
To that point, Rick, is that what started to happen this week? Away from residential, you brought up commercial real estate. Has this crisis, which Mohammed doesn't like to call it, and we'll come back to that in a moment, in the regionals morphed away from a rate shock to fears around a credit shock further down the road, perhaps even around the corner?
So, John, I mean, I think it would be naive to say that we're not going to see a tangible credit contraction. You think about where the epicenter of this lies. I mean, it's commercial real estate, but it's also the asset liability mismatch. It's a duration mismatch in regional small banks. Given the Fed stayed on hold for a long time, kept rates at 0, then you shock the rate higher, you bludgeon the capital of those entities. So think about the financing to small business, to local commercial real estate, that is going to have a real impact. That is real credit contraction that's going to take place. Big companies today have turned their debt out. They can get plenty of funding. You're going to create what's going to happen from here is a dynamic that you will have real credit contraction, particularly in those areas that are affected by the small and regional banks. But also, by the way, the banking system is only 15 to 20% of liabilities in the country. There's a bigger financial dynamic that has to be considered. So, my opinion is the Fed, they have to look at all these things, but clearly they got to be careful about this credit contraction that's coming.
Mohammed, what's your opinion?
So I think Rick is right in terms of we're going to get less credit extended to the economy. The question is how much less? Look, we are in phase 2 right now. It is different from phase 1. Phase 1 was a mishandled interest rate cycle, doing nothing and doing a lot very quickly, and poor supervision and regulation, exposing poor management. That was what those first 4 banks was about. Now we're in phase 2, where contagion, and in particular, people reacting to how the previous failures were handled, including First Republic, where you destroyed 97% of the value in the stock price during the process, people now have become very edgy. So now we have stage 2, where banks that are not particularly badly managed, they have issues, but they're not particularly badly managed, are suddenly vulnerable. And they're vulnerable to this path dependency, this multiple equilibrium. As you go down, and phase 3 would be widespread financial contagion. Hopefully we won't get there. But as you go down that spectrum, the risk of credit contraction goes up significantly. So it's very important to now do a much better containing this problem than we did in phase 1, which only contributed to phase 2 because of the way it was handled.
We'll return to this problem in a moment and talk about how to contain it. PacWest, a better day. That stock has had an awful week. We're positive there by more than 30%. Western Alliance up more than 25% right now, fading just a little bit, 20 minutes out from the opening bell. Rick and Mohammed are going to stick with us. Let's get you some movers. We can do that with Abby. Morning, Abby.
Good morning, John. And let's start out with the big one on the day, and that goes beyond the banks. Apple. We do have the shares popping, defying the naysayers who thought that Apple was going to be falling given the fact that earnings and revenue declining on a year-over-year basis. Now, that is happening, but we do have actually here we're looking at Lyft and Carvana, and you can see the dramatic difference between Lyft and Carvana. Lyft tumbling as the sales guide for the current quarter was lowered, having to do with the per rider economics diminishing. Carvana, on the other hand, really this troubled car sales company having a big lift here and a big quarter, up 41%, John.
Abby, thank you. Coming up, the economy showing resilience, regional banks looking shaky.
Another rate hike is really bad news for a lot of these banks. Regional banks suffered significantly in trading after that announcement. So, I think this banking crisis has got more legs to it.
After 6 days of losses, PacWest are leading the rebound in the regionals. That conversation up next.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. it enabled them to really utilize the vehicle that's different.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The situation we have right now is we have effectively unlimited deposit insurance. Only the difference is that the billionaires who are taking advantage of it and the billionaire banks that are taking advantage of it are not paying for it.
I'm not sure that last bit is true, but we'll let it go. The FDIC's deposit insurance fund needs a refill, and the big banks are set to foot the bill. Bloomberg reporting the US is, quote, poised to exempt smaller lenders from kicking in extra money and instead saddle the biggest banks with much of the check. This is the most battered regional banks rebound in the pre-market, PacWest leading those names higher after an ugly week of losses. Kelly Lyons, you spoke to Senator Warren. What's next?
Well, it's a good question. At the very least, and I don't want to jinx anything, it looks like potentially it may not be another working weekend for the FDIC in the world of financial regulation, as we do see the rebound in some of these names we were worried about. PacWest right now up 35%. Granted, that only goes so far to unwind the losses of the week. But as for the reason why we may be rebounding, perhaps panic is giving way to a harder look at the fundamentals, considering PacWest earlier this week said insured deposits represent now about 75% of the total. They've actually seen deposits picking up. There is also the consideration that the Fed released the latest data on its lending facilities yesterday, and demand for that dropped would suggest that some of those liquidity challenges are beginning to fade. Then there is also this idea that the FDIC may be letting the smaller guys off the hook in refilling that deposit insurance fund, which of course took billions of dollars in losses with the resolution of SVB and Signature Bank. So any institution with less than $10 billion in assets, we understand, won't have to pay those special assessment fees. That would apply to about 4,000 institutions, and even banks with less than $50 billion may also avoid those fees. It does raise the question, though, John, of whether we will see broader reform to deposit insurance. The FDIC released some proposals earlier this week, some of which include unlimited coverage or perhaps targeted coverage, which would raise the insured cap for businesses specifically. There is a massive question, though, as to whether or not Congress would get behind that. Yes, Senator Elizabeth Warren would like to see that insurance cap raised, but even some of her fellow Democrats, like Senator Cortez Masto, expressed to me yesterday concern about the moral hazard. And Republicans I've spoken with don't like that idea very much, John.
Kelly, great coverage, as always. Thank you. Back with us for a final word, Mohammed Al-Erin, Rick Reeder, alongside him. Mohammed, first to you. You talked about containment. Mohammed, what is the circuit breaker right now for the stress we're witnessing over the last 6 weeks?
One is for banks to continue to be more proactive. What's different this time around is when there's been uncertainty about banks, the institutions haven't allowed the adverse dynamics to build up momentum. They've come out. The second thing we need is quicker resolution, much better private-public discussions, because it's in everybody's interest to get to resolution quickly if needed. We can't drag it out like we did with First Republic. Somehow, and I really feel for Rick and my former colleagues at PIMCO, stabilize the front end of the curve. I don't know how they are navigating this incredible volatility. And then for later on, John, reforming deposit insurance. This is all doable, by the way. We just need to get it done.
Navigating the turmoil, the volatility. Rick, Mohammed has some sympathy for you. The 2 years had a lower 365 and a higher 416. It's another big range again this week, Rick. How are you navigating that?
Well, I look forward to Saturday mornings. I mean, listen, I think the way to do it is the markets are incredibly jumpy. They're incredibly illiquid. You get debt ceiling. I mean, the only way I found it's been fruitful to do it is just fade the extremes. I mean, the extremes you're seeing are intense. And I think the only way to do it is just go the other way when you get these extremes. Listen, we were on a call. We did the show last week, I think, Jonathan. We talked about, we're going to a deep recession. I don't think that's right. I think the Fed's still got to keep rates here for a bit of time. Listen, the only way the banking system really improves, in terms of regional small banks, et cetera, is at some point rates have to come down because you got to increase the price of their assets and you got to reduce the cost of their liabilities. That's got to happen. My sense is that's not going to be the next few months. So, you hide out. We talked about in your show commercial paper, really front end stuff that you get. I mean, you get 6% now. Like how often in your career could you just sit back and clip 6 without taking a lot of other commercial paper? Big companies that aren't threatening default in the next month or two. So there's a lot of things to do in the markets. Emerging markets, get outside the U.S. There's some things to do because the dollar's not going to appreciate like it did last year. There's some things to do, but you gotta be tactical as to when the markets seem to have these spikes of fear.
So, Rick, can you give me an example of that in the past week or so, when you've seen these big moves, where the Treasury market has been kicked around by what's happening in a couple of names, PacWest, Western Alliance? What are the kind of things you have done over the last few days?
So, Jonathan, I'll tell you, when you do things, you look really silly early. I mean, so, for example, the front end, the 2-year note, et cetera, it rallies, you sell some, it rallies again. And because you're getting these extremes and these fear moves, the first sale you make, you feel like a dope for having made it, and then you do it again. And then, and then ultimately, like today, it reverses itself. So it's trying to take advantage of that and have some fortitude around you're making the right decision around these extremes. But quite frankly, you try and do it in smaller size because, the trends tend to move until you get news to the contrary. So, trying to be active around it and trying to find opportunity. By the way, not just in rates. You think about the asset sales, mortgages, and other areas to try and be tactical. And when you see some of those extremes, when you hear rumors, there's some sales coming out, that's when you want to try and take advantage and buy some things. But it's very much like a counter trade. What is a jumpy, illiquid market.
It's been crazy, particularly the front end. Mohammed, you've covered that so well over the last few months. It's been the banking stocks this week that has kicked it around. I've heard from a lot of analysts quotes like this. This came from Cowen. We believe the banks are having their GameStop-like moment where social media is amplifying non-traditional approaches to assessing solvency. Truist said this: the recent sell-off in regional bank stocks is overdone as price action has been disconnected from fundamentals. Mohammed, that last line there, that the price action is divorced from the fundamentals. Aren't the fundamentals now shaped by the price action in the banking sector?
Oh, absolutely. It goes back to what will happen to credit extension. This is a really hard time. There's so many things moving. I feel for Rick having to get to Saturday, all of us are going to have to get to the end of the year where the Fed is telling us rates are going to be up here and the market is telling no, it's going to be down here. And the difference is 75 to 100 basis points. That difference has to be resolved before we all get to sleep well. So, we are not yet out of the woods because there is so much discrepancy in pricing and we no longer have anchors. Forward policy is not an anchor. The economy is not sufficiently an anchor and the banking system is not sufficiently an anchor. So this is a financial system that lacks anchors right now.
Mohammed, a number of Fridays ago, you said this wasn't a crisis. You pushed back a little bit around the term credit crunch. You said it's a bit more nuanced than that. On those 2 points, Mohammed, any shift in your opinion at all over the last week?
Yeah, I must say I'm more worried because I didn't expect that we're going to mishandle First Republic as much as we did and therefore make the market so much more jittery and therefore get these incredible moves on very little. I hope we can contain it to what I call the second phase. If we get to the third phase, which I hope we can avoid, then I'm going to go back and say, I'm sorry, this is a crisis. I don't think it's a crisis now. The big banks aren't involved. The banking system as a whole is not involved. But the cancer within that is starting to spread, and you got to keep an eye on that. It can be contained, but it hasn't been contained as yet.
Well, the scariest words right now, I think, for any bank stock, Rick, are these words: strategic options. But to Mohammed's point, because we know the template now, that when you hear the word strategic options over the last few months, that's ultimately meant that bank is going to hit the wall because no one's stepping in until it does. Rick, how do we prevent that from happening?
It's tricky. All of this is really tricky. Listen, I think we got to work through some of this process. And like I said, it's not the deposit outflow is obviously that, and I think the Fed Treasury has done a great job of stabilizing that. The problem is the asset liability mismatch, and I think we're going to have to keep working through some of these situations, and it's not easily fixed until the rate paradigm changes because of the nature of those embedded, because of what's embedded on balance sheet. So we're going to have a tricky period where capital has come down. And you got to work through that. But, like we said, this payroll number today, you've got an incredibly resilient, durable economy. As long as you don't get exogenous shock from whether it's debt ceiling, whether it's the financial transmission process, whether it's geopolitical, economy is pretty darn strong, and it has an incredible ability to withstand some of these influences.
Rick, is it even about deposits anymore? PacWest, they say this about their deposits. They say that insured deposits total 75%. Western Alliance say that number is at 74%. Over at SVB, uninsured deposits was more than 90%. It's such a different profile for the deposit base, yet here we are. Rick, is this even about deposits anymore?
I mean, I found it unbelievable, John. I mean, it was markets can only do one thing at a time. It's pretty unbelievable to me. They just, there's a laser focus on one thing. And you remember, it was just how much, and like we got to know the number, how many deposits came out. I don't think it is, because the funding, the Fed's done a great job of providing liquidity and backstop financing. So I don't really think it's a funding. It's the cost of the funding that is the salient issue. And I think, markets are becoming much more attuned to that. And like I say, the deposits, as long as you have durable funding through the Federal Reserve and through other sources, then it really just becomes, what's your asset liability mismatch? How much capital do you have to raise? How many assets will you have to sell to try and manage your liquidity in the system? But no, I don't. But to manage, liquidity / capital, that's where I think the focus needs to be.
Mohammed, I want to give you the final word, because you've said this a few times over the last few months. When the three of us have been talking about the labor market and inflation and this Fed, you've said that ultimately perhaps this Fed will have to accept or tolerate a higher inflation rate. Mohammed, given what's materialized over the last couple of months, what continues to evolve, do all roads still lead to that destination for you? Because this Fed was so late that ultimately they're just going to have to accept or tolerate higher inflation?
Yes, in the sense, John, we are deep in the world of second best. There is no optimal policy response. We lost that because the Fed didn't react quickly enough. So in this world of second best, among bad choices, this is the better. The alternative of just going for 2%, regardless of what you do to growth, regardless of what you do to the financial system, is not a good one. And the other alternative of actually moving your inflation target explicitly at a time where you've lost credibility is also not a good one. So you've got to somehow continue to convince people that you're aiming for a good destination and just manage the journey a lot more responsibly.
Mohammed, looking forward to your commentary over the next few months alongside Rick Reader. To two of you, thank you for joining this program. Two of the very best on this market and on policy. Coming up shortly, Dan Ives of Apple, Anastasia Amoroso, iCapital, Mike Collins, PGIM. Your opening bell is up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Live from New York City, about 22 seconds away from the opening bell this morning. Good morning to you. Payrolls report looking pretty decent, solid, resilient, pick your word. Equity futures right now positive 0.9% on the S&P 500. On the NASDAQ, positive 0.7%. Through Thursday, down on the week. Down for 4 straight days on the S&P 500. Let's see if we can snap that this morning. There's the opening bell, switch at the board and get to the bond market. Yields look a little something like this on a 10-year, higher by 6 basis points, 3.44 on a 10-year. Dollar showing a touch of strength against the euro, a little weaker. A break of 110 to the downside, 109.86. We're negative there by 0.2%. And crude back through 70, up to 3.7% higher right now, to $71 and about 10 cents. 20 seconds into the session, we look a little something like this. We are positive 0.9% on the S&P, on the NASDAQ, up by 0.9% also. One stock supporting the price action, Apple, snapping a 4-day losing streak after reporting better than expected revenue on robust iPhone sales. Ed Ludlow covering the story on the West Coast for us. Morning, Ed.
Yeah, good morning, Jonathan. Up 3%. So services actually missed expectations, but it was one of just 2 categories that actually grew year on year. About a 5.5% gain relative to the same period a year ago. The other outperformer that beat expectations was iPhone sales. Just 1.5% sales growth year on year, but it shows that Apple's weathering the kind of tough environment for smartphone demand globally. Real strength in emerging markets. Tim Cook talked a lot about India and emerging markets broadly. In terms of the limited guidance that we got, it's really interesting to note the impact of FX here as a headwind. About 500 basis points in the quarter gone, but note the forward-looking statement that going into the current period, while there will be an FX headwind to the top line, we actually expect FX to be flat as an impact to the bottom line. And that's the first time for Apple that's happened in a lot of quarters. They're really talking about India. They see a growing middle class, and Tim Cook's hope is that more of that growing middle class in India will buy iPhones. That's literally how he put it. A lot of emphasis on the financial services side of the business being a driver of performance as well. And then the buzzword, AI. He was asked about AI by one of the analysts. It was much more muted than we saw from his mega cap tech peers like Meta or Microsoft or Alphabet. But he did say that AI is huge in Apple's eyes. They will be thoughtful about how they integrate it more deeply alongside machine learning into the product base. And again, it was a record quarter for a number of categories, but the important bit is that another record quarter globally for the installed base of products across the entire lineup. So it seems like this was robust print, John.
Looks like it. Looking at the stock move. Ed, thanks for that. Great coverage yesterday evening as well. Apple up by 3.4%. Dan Ives of Wedbush coming up in about 6 minutes' time. Looking forward to that conversation. More from the south side. Jefferies resuming their buy rating on Apple after earnings. They said this: few things in the market are as certain as Apple's cash-generating abilities, product resilience, and remarkably high consumer sentiment. The March quarter had all 3 on display. That stock, 171 in early trading. Let's get to the banks, the regionals, from big tech to some struggling names. PacWest rebounding after plunging almost 70% this week. Its peers following suit heading into the weekend. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, in some ways, the move that we're seeing this morning
defies fundamentals. The exact catalyst here may be unclear, but we did get some good news out of some of these names. PacWest in particular, well, it did confirm that it's in talks with several investors. It also said this week that deposits have actually risen since March. And Western Alliance, too, said that it hasn't seen any unusual deposit flows since, of course, First Republic collapse, which, granted, was just a couple of days ago. And Bloomberg News also reporting this week that the FDIC will exempt some of these smaller banks from having to kick in extra money to that deposit insurance fund. So some relief there, John. But the reasons for today's rally could be as simple as this sell-off had gotten really dramatic. Even with today's rally, let's focus on PacWest. It's down more than 50% this week alone, so we could be watching some knife catching going on.
It was a double-digit stock to start the week. Brutal stuff over the last couple of days. Katie, wonderful, thank you. Let's turn back to the earnings. Two names, Lyft, Carvana. Lyft plunging after delivering a disappointing sales forecast. Carvana, on the other hand, expected to turn a profit following a strong Q1. Abby has more. Hey, Abby.
Hey, John. Yeah, truly a tale of two different car stocks here and stories, fundamentals happening here. Now, starting off with the shares of Lyft, they are plunging, the worst day since February. And as you said, the quarter that was, not so bad. But the quarter that is, the profit, they took the sales guide below what it was expected to be. Carvana, on the other hand, the used car sales company that has had some going concern risks in recent months, well, it's soaring on the company saying that it will return to a profit in this current quarter. Now, if we return to Lyft, what's going on here, it seems that the demand for ride sharing is pretty strong, but the per rider economics diminishing. So their second quarter revenue range slightly light, the EBITDA range a little bit light there. They're basically sacrificing the near term to gain share from Uber in the longer term. Relative to Carvana, the used cars markets is stabilizing. The first quarter was strong. So they do see this profit coming this quarter. They're seeking to cut debt. The amazing thing about this stock, John, over the last 2 years, it has gone from anywhere between a $3.72 stock to a $372 stock. Not surprisingly, there's a massive short interest, a 50% short interest, sending that stock higher today. Let's see where it lands as this year trades on.
Their biggest problem right now for Lyft, they're not Uber. Lyft right now is negative 19%. Abby, thank you. Let's get back to Apple. Analysts across the board highlighting their solid results amid a challenging backdrop. Wedbush's Dan Ives calling them LeBron-like results in a shaky macro. He goes on to write, quote, the iPhone beat was front and center and is clearly an indication that where gains in China are continuing despite a murky macro, Apple remains our top tech pick. Dan Ives joins us right now. Now, Dan, I know you're constructive, so work with me. This is from your own note. Total revenues down year over year. Let's go through piece by piece. iPad revenues down year over year. Mac down year over year. China down year over year. Dan, is this a growth stock anymore?
Yeah, but look, you got to think about the 500 bip headwind from FX, which is important when you look at what real called constant currency growth is. Look, China increased 500-600 bips sequentially, and I think into the next few quarters you're going to see growth and go into next year double-digit growth. I think it's about that install base. I mean, they're further monetizing it. They're gaining share in China. And ultimately, from a street perspective, it was a Goldilocks quarter.
Let's talk about the buyback plan as well. Another $90 billion, raising their dividend for an 11th year in a row. Can you frame down how powerful that is? I had one analyst say to me and the team yesterday that if you don't want the stock, Apple's going to buy it anyway. Is that how powerful that buyback plan is?
It is. Look, and I think right now it's a safety blanket stock in what's a shaky macro. And you're seeing that across big tech. And for Apple here, this is just a further flexing of the muscles from the buyback dividend to what's happening in China. And you really start to think about the narrative here with services now starting to show an uptick on the App Store. If you think about the reasons not to own it, I get valuation as some continue to sort of view a glass half empty. Some of the parts, we think this is a stock that goes north of $200.
Services came in a little bit lighter than expected, Dan. The way you painted the picture just then was a constructive way. Why is that?
Yeah, I view it as it's an inline services where the whole focus is can this start to go back toward double-digit growth into the next 2 to 3 quarters. And if you look at the tea leaves with Cook and Cupertino, how they're laying everything out, I think we'll see more at the developer conference in June. I think this will be back double digits in the next 3 to 4 quarters. And just given the macro, it's sort of a shining light in a dark storm. And that's why I think more and more investors that were underweight Apple and they continue to yell fire in a crowded theater, they're just going to have to be forced to owning this because of what's ahead on the product cycle.
Dan, I was speaking to Pierre Farago of New Street Research. He's kind of middle of the road on this name, and there's huge conversations about how to value the stock, what multiple to put on it. Pierre and I had that conversation this morning. Is it a growth name anymore? You suggest it is. Is it a luxury player? LVMH-type margins without the price resistance to some of the iPhones. What is it, a staple? Dan, how do you value this company?
Well, first off, in margins, Keen talks about this a lot. If you look now with owning more and more of the chips in the supply chain, I mean, margins are actually increasing, even in a negative growth when you factor currency in. And I think this is all about the install base. 25% of the install base has not upgraded their phone in 4 years. And I think that's ultimately going to lead back to growth, back to double-digit growth. And China, it ultimately is increased not just sequentially, but into next year. So in the macro, it's obviously better than anyone out there and from a tech perspective. But I think it's about what it looks like into the next 4, 6, 7 quarters. Betting against Cupertino, I mean, it's like betting, against Steph Curry, in my opinion.
Well, Steph Curry or LeBron, you've got to pick someone, Dan.
Look, LeBron obviously is the GOAT, but in this series, I think Steph, could be carrying it.
Dan Ives, thank you, buddy. Still constructive on this name. That name is up now by almost 5% in early trading, about 10 minutes into the session. Looking at the broader market, we're up by more than 1 percentage point on the S&P 500. On the NASDAQ, up by a similar amount, and a big bounce back in some of these banking names. Let's get PacWest and Western Alliance up on the screen. PacWest on my screen has been halted, up by more than 40%. Western Alliance is flying as well. Western Alliance, they're up by 59%. Big moves for some of those names. Big moves. Up 33% on Western Alliance right now. Let's get to Y Capital's Anastasia Amoroso. Mike Collins at PGIM joins us now. Anastasia, how hard is it to be constructive on this market, given everything that's been happening over the last couple of weeks?
Well, I think it's gotten a little bit harder, John. And the reason I say that, we had a nice recovery in the second half of April. And at the same time, there's two risks. They're really unresolved right now. And the first one is the banking turmoil. And I appreciate that some of these bank names are up today, but you know what? There's no fundamental reasons for why they're up. And as you talked about earlier in the program, there's no circuit breakers yet in place to end this banking turmoil. So that's one issue that I think markets have to grapple with. And then the other issue, which people are probably not talking enough about, is the debt ceiling. But as you know, the debt ceiling needs to get resolved by sometime in June, and the time to do it is May. So I worry that the policymakers may drag their feet on resolving both of those, mini crises. And for that reason, I'm a little bit less constructive, perhaps near term, as I was coming into April.
That's a change for you, Anastasia. How are you expressing that change over the last month?
It is a change. And, coming into April, the view was that it's definitely we're poised for an optimistic shift, and you want to be long stocks. And, I think as stocks have sort of recovered and maybe some of the tech names have rallied quite a bit, maybe you do pare back some of those gains. Maybe you write some call options on them, especially because volatility has spiked once again. But I do want to make an exception, John, that, I do think the tech resilience may actually continue. And so any sort of weakness that we get in tech in particular, I would be a buyer of. But trimming, whether it's a rebound in financials or trimming some of the cyclicals or trimming some of the small caps, to the extent they have any recovery, I would very much focus on getting out of the kind of economically interest rate sensitive names and getting into more defensive tech.
Mike Collins, what do I do with this treasury market? And great to catch up with you, buddy. It always is. Mike, do I buy it because of ultimately lower growth and financial stress? Do I sell it because the data looks decent?
I love to come on here and pound the table with a lot of conviction, Jonathan, but with the 2-year bouncing around 4 and the 10-year bouncing around 3.5, it's really hard to pound the table on interest rates. Right now, what's being priced in, if you really step back and look at the big picture, the tail risks, as we've talked about, are really fat. There's probably about a third probability of a really strong economy, like GDP growth around 2%. With higher inflation, there's a 1/3 probability that growth just kind of stalls towards 0. And then, of course, there's this big downside, nasty 1/3 probability tail of something much worse, a deeper recession. So if you have the good scenario, rates probably go up 100 basis points. If you have the bad scenario, they probably go down 100 basis points. And here you are kind of stuck in no man's land in the middle. So what we're doing is really looking for backups in yields here to add duration. We are not adding, we are not long at these levels. And I think that's the right thing. I mean, with the funds rate at 5.25 and the 10-year at 3.5, I mean, that is really inverted. And that 10-year ultimately could get dragged back up if the Fed is able to hold its ground, which is very possible. So you wait for rates to back up a little more, then you add duration. And the same with credit spreads.
Mike, can you think of anything that works in both scenarios?
Yeah, I mean, bonds, right? I mean, this is actually, if rates back up or stay where they are, Jonathan, you're earning these really big yields in high quality fixed income. It might be a once in a generation type of opportunity. So that's the good news. In the downside scenario, this is a very different world than last year, right? If you have that deep recession, and presumably in that world, inflation does come down, the Fed doesn't cut rates 100 basis points, they cut rates 300 basis points, and bonds kill it, right? So I think it's a carry story, in the upside, and it's a capital gain story in the downside. So this is definitely an opportunity over the long term to have more fixed income in your portfolio.
Mike Collins, Anastasia Amoroso, sticking with us. We'll have a conversation about the latest from the president. He says, my plan to invest in America is working following a robust payrolls report. The U.S. payrolls report coming in hot.
The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
The reaction from Washington, up next.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
for is this immaculate disinflation where you just slowly weaken the labor market. Unemployment rate only goes up to about 4.5%. The Fed's not going to quit until the labor market quits. And this is not a quitting labor market in these data.
President Biden likes what he sees. This is what he tweets, quote, "That's 12.7 million jobs since I took office, an unemployment rate that is the lowest since 1969 and the highest share of working-age people in the workforce since 2008. My plan to invest in America is working." AMH joins us now in Washington for more. Morning, Anne-Marie.
Good morning, John. Well, this is an interesting one for the president because, of course, this is the first jobs report we have since he announced he's running for 2024, and he's making his pitch once again for the American people. He's talking about the fact we have this low unemployment rate since May of 1969, and, of course, this massive beat on the payrolls front. Of course, the president's not going to get into the nuance that you and I are going to do, which is, of course, the revisions of 149,000 jobs to the downside, but this is a strong report for them to tout some of these really incredible numbers in the jobs report. Of course, Jonathan, we have to remember 18 months away. That is when we have the next election, and Republicans are going to try to use the economy, most notably inflation, against this president, but expect more from him later today. He's gathering with his cabinet to talk about investing in America, and ahead of those comments about investing in America, what his cabinet and he is doing, he's going to talk about this jobs report.
Lots of nice things to say about the jobs market. I'd like to hear a whole lot more about what's happening with the financial system. Anne-Marie, thank you. Down in Washington, for a final word, Anastasia Amoroso, Mike Collins back with us. Anastasia, is there a good reason right now to buy regional banks?
No, Jonathan, I don't think so. I mean, I think for regional banks, it's a bit of a vicious cycle right now, which is the shares are under pressure and investors and depositors lose confidence, and then deposit outflows can still very much be on the table. And if that's the case, then that potentially can lead to more short interest if that's possible in some of those regional banks. I mean, that's kind of the market cycle vicious scenario. But the other side of it is you've got funding costs that are still rising, have to rise for these regional banks. And at the same time, lending is becoming incredibly constrained and the demand is falling, the supply of lending is falling. So that's just not a good outcome for net interest margins and for net interest income. So I think it's still a very much challenged area until you either have the Fed that starts to cut rates or you have the FDIC insurance that actually does cover all the uninsured deposits. Until that, I just don't see a big opportunity in equities and bank equities.
21 minutes into the session, PacWest up by 48%, Western Alliance up by 34%. That's a bounce back, Mike Collins. That's the equity picture. Anastasia went through it there. The profits, they're going to be challenged, Mike. On the debt side, what does the picture look like?
Yeah, it's not a great earnings story, Jonathan. So as a debt holder, you don't really have to worry about earnings growth too much. We are not involved in the regional banks, thankfully. The big money center banks are benefiting, right? They are growing. A lot of people say, why don't the big ones buy the small ones? And obviously you've seen a little bit of that with JP Morgan, but they're already acquiring their business, right? They're acquiring their loan growth, they're acquiring their deposits. The capital ratios of the big banks are awesome. They are really, really good debt investments. We own a lot. We've been adding to them on weakness here. It's a really good opportunity for fixed income investors.
Where are you taking credit risk more broadly at the moment, Mike? Where are you more comfortable doing so?
Yeah, you know, it's really interesting. I mean, you're not getting paid again, you know, not to sound like a broken record for going down in quality here. That 1/3 downside tail I was talking about earlier is not priced into the markets, right? That kind of slow, you know, soft landing is what's priced in here. I mean, credit spreads could be wider, probably will be wider in 6 and 12 months as those tightening lending standards that Anastasia mentioned really come to the forefront. So you stay in the banks, you stay in agency mortgage-backed securities, which have gotten killed. You stay in, you know, AAA asset backs, and you buy all these high-quality bonds. Maybe you're, you know, a handful of your favorite high-quality, high-yield bonds, which are still attractive given their default fundamentals, and you build a portfolio that's out yielding, you know, treasuries or your benchmark by 200 basis points. I mean, that's what the markets are giving you right now, and it's a really good long-term opportunity.
Just another wild week. I think we're all itching to get to the weekend. I'll let you both go. Anastasia Amoroso, Mike Collins, to the two of you, thank you very much. About 22 minutes into this session, the broader market, better than okay. It's a bounce back. We're on a 4-day losing streak on the S&P. We snapped that on the S&P 500 up by more than 1%. Let's get you some sector price action Here's Abby.
And your idea on a wild week is certainly shown here sector-wise, John, because on the day we have most sectors higher. In fact, energy up by 3%. Many of the sectors, most sectors up by more than 1%. But if we take a look at the week that was, not so much. All 11 S&P 500 sectors lower. Big losses. These are the worst. Energy the best today, but worst on the week, down about 6%. Then you have the communication services down. That was some of those mega cap techs. Financials, not surprisingly, down. And then the materials down, too. So much volatility, John.
Abby, thank you. Your trading diary up next.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Attempting, trying to take a chunk out of a weekly loss on the S&P 500. About 26 minutes in, we are positive by a little more than 1% on the S&P. On the Nasdaq, up by a similar amount. And those two names, PacWest, Western Alliance, bouncing back as well. Let's see if it stays that way. That's the price action. Here's the trading diary into the weekend and beyond. Fed speak picks back up this afternoon. Bullard and Cook, 1 p.m. Eastern time, Monday. The highly anticipated Senior Loan Officer Opinion Survey, followed by President Biden's debt limit meeting with congressional leaders on Tuesday. US CPI on Wednesday, PPI and another round of claims on Thursday to get you towards next weekend. Let's get to this weekend. Enjoy your weekend if you can. From New York, this was the countdown to the open. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does. Is it the OK is getting ready to make a decision?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud, the Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349